I think we're back live. I don't know what is going on with my internet. It's kind of whack. We do have a GameStop hearing, though, that we can watch. So we will watch it, I suppose.
Don't press that skip ad button. I can guarantee it will be the biggest financial mistake of your life. Done just as much as we did in the first hearing.
No, I don't have Spectrum.
Hear the same policy solutions from my Democrat colleagues. The repackaged old, outdated policy failures wrapped in whatever's in the news this week to sell the American people on the idea that this time is different. Well, it's not. Like so many other bad progressive ideas sold under the guise of investor protection, which I think is important, Democrat proposals will ultimately reduce access to investment opportunities and charge DC bureaucrats and give them control of investing decisions of everyday America.
I guess we're just going to watch
this. If this committee is interested in responding to late January's events, we need to expand the accredited investor regime, not restrict it. It's ridiculous that our securities laws force most everyday Americans to the sidelines of early growth opportunities, investment opportunities. We need to find innovative solutions that allow more people to invest in businesses they support while retaining the flexibility our changing workforce needs and requires. This week, I reintroduced my bill, the Gig Worker Equity Compensation Act, to expand the category of workers that can benefit from equity compensation to include non-traditional workers. If you want to see the juxtaposition of Democrats and Republican priorities right now, just yesterday, the Biden administration moved to dismantle past efforts to provide gig workers with the flexibility they demand, that they need, that they require. If a state as liberal as California can recognize that a one-size-fits-all mandate on gig workers would be destructive, it should be obvious that the Biden administration should not take those same actions that went down at the ballot box in California. These actions that hurt non-traditional workers, not help them. I initially called for this hearing on GameStop to begin the process of fact-finding to inform our policy discussions. And the bottom line is we're still gathering a number of facts. That's why we have representatives from FINRA and DTCC testifying before us today. I think that's a good thing. Additionally, the SEC's review of the events is ongoing, and as is the committee's work behind the scenes in terms of document review and interviews. Despite the ongoing investigations and the testimony we'll receive today, many Democrats have their so-called solutions. A lot of these things have been kicked around for a long time. At our first GameStop hearing, I asked Democrats to side with the everyday American investors. I'll make that same ask today. We should not punish everyday American investors with a Democrat agenda, progressive agenda that results in fewer investment options or forces folks to start paying to make trades again. So let's go off of what we've learned. Let's stand up for everyday investors and make it easier for them to invest. And let's tear down barriers keeping folks out of the market instead of throwing up new ones to impair their ability to be in the market. Let's stand up for equity, true equity, and that's ownership. Ownership of the American economy, ownership in our capital markets, so we can remain the center of the free world's economic policies. And so with that, Madam Chair, I yield back.
Thank you very much, Mr. McHenry. I'm pleased that you see something good about our hearing today. I now recognize the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, the gentleman from California, Mr. Sherman, for 1 minute.
I thank Chairman Gessler for being here, and I hope he joins us often. The ranking members concerned about whether gig workers in my state have the protection that we accord employees. It's a little far from the mandate of our committee. But within our committee's jurisdiction is to make sure that when investors trade stocks, they get the best possible deal and are not told that there's zero transactions cost when the big transactions cost is the spread and you are paying for the transaction unless you're getting the best possible price improvements. Price improvement may not be fully available if your broker is getting paid for order flow, or if your broker is acting as the market maker. We also need to look at short sale disclosures. Right now, there are disclosures filed with the SEC quarterly. That is so 1977. You would expect reports to be filed far more often. And we have to discuss what reports should be made public. And I look forward also to looking at margin selling.
Thank you. I now recognize the ranking member of the subcommittee, the gentleman from Michigan, Mr. Huizinga, for 1 minute.
Thanks, Madam Chair. Advancements in technology have improved access to our capital markets and created new opportunities for countless Americans to participate in our markets who were previously excluded. App-based interfaces combined with zero commission trades, fractional share trading, and lowered account minimums have ushered in a new generation of investors. However, instead of celebrating this new era of investment, how have my colleagues across the aisle responded for the most part? By falsely claiming that this increase in market participation has caused gamification of the trading experience, markets are rigged, and some have even gone so far as to say and equating it to gambling in a casino. Well, as Rahm Emanuel famously said, you never want a serious crisis to go to waste. I mean, it's an opportunity to do things that you think you could not do before, close quote. Well, that's exactly what my friends on the other side of the aisle are doing. They're exploiting a high-profile situation to push a radical progressive agenda where these proposed small d democratic solutions that will only further prevent everyday American investors from accessing our capital markets and denying them the opportunity to further save and invest for a more prosperous future. I yield back.
Thank you. I want now to welcome today's distinguished witnesses to the committee. First, we have the Honorable Gary Gensler, who is the recently confirmed chair of the U.S. Securities and Exchange Commission. This is Chair Gensler's first time appearing before the committee in his current capacity. He has previously served as chair of the Commodities Futures Trading Commission and in several senior roles at the Department of the Treasury. Next, we have Mr. Michael Botson, who is President and Chief Executive Officer of the Depository Trust and Clearing Corporation. And finally, we have Mr. Robert Cook, who is the President and Chief Executive Officer of the Financial Industry Regulatory Authority. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Chair Gensler, you are now recognized for 5 minutes to present your oral testimony.
Good afternoon, Chairwoman Waters, Ranking Member McHenry, and members of the committee. I'm honored to appear before you today for the first time as chair of the Securities and Exchange Commission. I've been in front of this committee multiple times in multiple administrations, and I will say this, I look forward to the day where we can meet in person in your beautiful hearing room again. Thank you for inviting me to testify on January's market volatility, and I'm pleased to be here with Mike Botson and Robert Cook, who I've known for a number of years as well. I'd like to note that my views are my own, and I'm not speaking on behalf of my fellow commissioners or of the SEC staff. These events are part of a larger story about the intersection of finance and technology, which have lived in a symbiotic relationship since antiquity. And one thing that I've come to believe is that technology can bring greater access to our capital markets. Our central question is this, though. When new technologies come along and change the face of finance, as they have done for decades, how do we continue to achieve our core public policy goals? In my role, I will always be animated by thinking about working families in the SEC's three-part mission: protecting investors, promoting fair, orderly, and efficient markets, facilitating capital formation. I'm pleased to submit written testimony that goes into detail on several factors at play during January's events. I'll just highlight a few of those key issues in this opening statement. First is gamification and user experience. I agree with the members who have already said these new user experiences have facilitated a lot for investors. They've expanded access to capital, making it easier for investors to sign up, start trading, learn about investing. These apps also use a host of features that have come to be familiar in our increasingly online world, such as gamification, behavioral prompts, and predictive data analytics. Many of these features, in essence, encourage investors to trade more frequently. This could have a substantial effect on a saver's financial position. Some academic studies suggest that the more actively you trade, the lower your returns. So while they're encouraging investing, they may also be encouraging active trading. I've asked the staff to prepare a request for public comment on these issues. The SEC must remain attuned to rapidly changing technologies with an eye to freshening up our rule set where appropriate to continue to achieve our mission. If we don't address this now, the investing public, those saving for future retirement and education, may shoulder the burden later. The second topic I'd like to discuss is this area around payment for order flow. This practice brings to mind a number of questions, including whether it creates inherent conflicts of interest between the broker-dealers on the one side and their customers on the other who want to achieve, under our rules, best execution. Now, it's important to consider this, I think, in the overall context of market structure. Currently, a significant amount of retail orders are routed to a small number of wholesalers. I detail this more in the written testimony, but I think it raises questions about whether the market structure best promotes fair, orderly, and efficient markets. Evolving market technologies, along with this payment for order flow, has also led to increasing market concentration, which we've found, history and economics show, concentration can lead to fragility in markets, deter healthy competition, and limit innovation. The next issue is short selling and market transparency. And again, as outlined in the testimony, under Dodd-Frank reforms, the SEC received mandates and authorities to increase transparency in the market. So I've asked SEC staff to prepare recommendations on transparency in short selling, stock loan markets, and something called total return swaps, which was at the center of this Archegos events in March, for commission consideration. And the five of us commissioners can take a look to see what to do next. Next, today's social media tools have far greater reach, scale, and anonymity than previous technology. This raises the possibility that wrongdoers will attempt to use their powerful forums to hype certain stocks or manipulate markets. I'm not concerned about regular investors exercising their free speech rights online. I'm more concerned whether bad actors potentially take advantage of influential platforms. Further, is the decisions by some broker-dealers to redirect customer trading raised several issues around clearance and settlement. In essence, they stopped investors from investing. And this raises questions of the market, what I'll call plumbing. Sorry to Mike Bobson if I call the infrastructure plumbing. But investors were shut out. I do believe we can lower costs and risk in our market by shortening the settlement cycle. For instance, I've asked SEC staff to put together a draft proposal for the commission on the possibility of shortening the settlement cycles. I thank you. I look forward to your questions. It's good to be back with you. And again, I look forward to doing this in person.
Thank you, Chair Gensler. Next, we will go to Mr. Botson. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee. My name is Michael Botson, and I am the CEO of Depository Trust and Clearing Corporation, a holding company that operates 3 SEC-regulated clearing agencies, including National Securities Clearing Corporation, or NSCC, of which I will speak to today. I appreciate this opportunity to speak to the committee. In my line of work, the best days are those when nothing too exciting happens. That's because DTCC is, at its heart, a risk management organization, enhancing efficiencies and reliability in the markets. On a normal day, we process about 200 million buys and sales for a value of nearly $2 trillion. Through netting, that is reduced to about 1 million securities movements and 35 billion in cash movement, creating significant efficiencies in the market. When you buy or sell a stock, it takes 2 days for the trade to be completed. This is called T+2 settlement, trade date plus 2 days. A lot could happen during those 2 days that could create a risk that the buyer or seller fails to deliver money or shares. Because of clearing, investors don't have to worry about that. Clearing protects both firms and their customers against default risk. Default risk can destabilize markets, particularly in volatile times. People are reluctant to trade if they aren't sure they will get what they agreed to. And imagine how inefficient it would be for every market participant to assess the creditworthiness of everyone else in the market. That's where DTCC comes in. We are infrastructure. You can call us plumbing. We're not insulted. We operate behind the scenes to guarantee completion of virtually all equity trades. We do not trade or take positions or bet on the direction of the market. We do not give investment advice. We do not know who the customers are behind the trades or their reasons for trading. We simply process and risk manage trades. DTCC protects against default risk by collecting margin, which is money that clearing members post as collateral. If a clearing member defaults between trade date and settlement date, DTCC uses that collateral to complete the defaulting member's trades, no matter how much prices may have changed. Margin requirements are calculated using statistical models and model-based calculations that are set forth in our rules, which must be approved by the SEC. Margin requirements increase as the risk in the member's portfolio increases. In other words, the greater the potential loss a default could produce, the greater the need for collateral. Volatility has a very large impact on margin requirements. We saw this play out during the week of January 25th. Both volumes and volatility that week were extraordinary. On January 27th, NSCC processed about 474 million transaction size, exceeding the pandemic-related record volume from March 2020 by more than 100 million trades. The concentration of trading in a small number of meme stocks that week was also extraordinary. Applying those statistical models and formulas, margin requirements increased substantially for firms with large volumes in these stocks. I appreciate that the committee is exploring ways to continue to improve our markets. I'd like to describe one effort that DTCC has undertaken to date, shortening the settlement cycle for equities from 2 days to 1 day. That may sound like a small thing, it's just 1 day, but cutting the settlement period in half can make a difference. We believe that shortening the settlement cycle to T+1 would enhance market resilience, reduce margin requirements, and lower costs for investors. Following a multi-year industry-wide effort, settlement was shortened in 2017 from T3 to T2, achieving margin savings estimated at 25%. DTCC estimates that the volatility component of margin requirements could potentially be reduced by 40% with a move to T1. This could save our clearing members upwards of $6 billion per day during periods of extreme volatility. While DTCC's technology can support T+1 today, changing the industry convention is a major undertaking that will require coordinated efforts across the whole industry. Over the past year, DTCC has engaged with a cross-section of the industry to assess readiness to further shorten the settlement cycle. In February, DTCC published a white paper outlining the benefits associated with multiple changes to the settlement cycle, including a move to T1. We are working with SIFMA and ICI to accelerate this effort. Thank you again for the opportunity to testify today. I look forward to your questions.
Thank you very much, Mr. Boughton. Now we will go to Mr. Cook. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters. Thank you, Ranking Member McHenry and members of the committee for this opportunity to testify today, together with Chair Gensler and Mr. Bodson, regarding the January market events related to trading in GameStop and certain other stocks. We commend the committee's review of these events and related investor protection concerns. FINRA's mission is to protect investors and promote market integrity. We are a not-for-profit SRO, and we support the SEC in overseeing one critical part of the securities industry, certain broker-dealers and the individuals they employ. To that end, we administer comprehensive regulatory programs, including surveillance, risk monitoring, examination, and enforcement. And we, in turn, are subject to comprehensive examination and oversight by the SEC. This committee has heard already about the events of January including the significant price swings and trading volume in GameStop and a limited number of other stocks. In this context, some broker-dealers restricted trading in these securities on a short-term basis. This led to confusion and frustration among some investors and concerns about the fairness of the markets. The events also focused attention on the growth of popular new retail trading platforms and services, changes in investor behavior, and the influence of social media on the markets. Our markets are dynamic and continually evolving. Market participants constantly innovate new technologies, methods of communication, and investment products and services. These innovations often benefit investors, such as by providing easier access to the markets, lower costs, and a wider range of investment products and services to choose from. But they can also present new and sometimes unanticipated risks. So regulators must constantly review whether the rules governing the road need to be updated in light of new developments to better protect investors while still facilitating vibrant and innovative markets and the opportunities these create. At FINRA, we are committed to doing just that. One important resource we rely on in this process is the research of the FINRA Investor Education Foundation, including recent research on new, inexperienced investors and how they approach investing. Since the events of January, FINRA has established an internal working group that's devoting significant resources to investigating whether its broker-dealer members complied with SEC and FINRA rules. We have also issued regulatory notices reminding firms of relevant duties and responsibilities in this area. Although I cannot comment on specific firms or ongoing investigations or enforcement matters, generally speaking, we are reviewing order routing practices, the circumstances under which trading restrictions were imposed, any potential manipulative conduct, and compliance with short sale requirements, among other matters. I can assure the committee that we will take all appropriate disciplinary or other remedial action as warranted if the facts indicate a violation of SEC or FINRA rules. The upcoming SEC report on these market events will be critical in analyzing whether existing rules and standards should be updated. Many of the policy questions raised in your hearings to date involve areas in which the SEC has primary policy-making responsibility, such as market structure, payment for order flow, short sale regulation and disclosure, the settlement cycle, enhanced broker-dealer financial responsibility requirements, and whether certain communications with retail investors constitute recommendations that should be covered by the SEC's regulation best interest. We will support the SEC in its review of these areas and then align FINRA's rules and oversight activities where necessary or appropriate. My written testimony offers some further perspectives on key topics under the SEC's jurisdiction and also describes some areas where we are considering whether updates or guidance regarding our own rules would be appropriate. For example, we intend to review short sale position reporting by broker-dealers, as well as continue our review of the effects of gamification on retail investors. FINRA looks forward to working with this committee, the SEC, and our fellow regulators to review and learn from these recent market events so that we can strengthen investor protections and enhance confidence in our nation's capital markets. Thank you, and I'd be happy to answer your questions.
Thank you very much, Mr. Cook. I now recognize myself for 5 minutes for questions. And this question is for Chair Gensler. This committee has examined numerous issues that have arisen out of the GameStop short squeeze that took place earlier this year, including systemic risk arising from firms such as Citadel, who are executing close to 50% of all U.S. listed retail volume. During the first hearing, I questioned whether Citadel poses a systemic risk to our financial markets. I'm also concerned about what Citadel's outsized market impact means for pricing and best execution, another market structure issue that this committee has examined as part of these hearings. As a newly confirmed chair of the SEC, what will your approach be with respect to mitigating the risk associated with outsized market impact and understanding threats to our financial stability?
I thank you for that question. I thank you for that question. I think that at the heart of well-functioning markets and the mission of the SEC, fair, orderly, and efficient markets, is promoting competition in markets. It can be done through transparency, but it's also by looking at our rule set to make sure that our rule set inspires more competition rather than concentration. And we have seen, as you noted in your hearing, an increasing concentration in market making and also separately in brokerage, and particularly around retail order flow. And so I've asked the staff, both from the Division of Economic Research and Analysis and Trading and Markets, to sort of give us a view, give internally the commission a view. What should we be thinking about in our market structure to address this? We've seen such concentration come in other markets. We know it's in search. When we all go online and search, there's really one dominant search engine. We know it's true in retail, buying retail products online. There's some dominance to that. And so our modern 2020s economy does tend towards certain, what's called in economics, network effects. So I've asked the staff just to think through that and to help provide us with guidance as commissioners. How do we promote competition in the face of these network economic effects that are leading to concentration?
Well, I want to thank you for that response. And I think what I'm hearing from you is that there is real concern about concentration. And while you have instructed staff to do some additional research to determine the extent of it, it is something that we should be concerned about. Is that correct?
Yeah, yes, I think that capital formation for issuers and for investors on the other side benefit from some broad competition amongst market actors. And as we get more concentration in the middle of the market, whether it's market making or brokerage, we could lose that concentration, could lead to more fragile markets, meaning less orderly, and also more costly or less efficient markets. And that's what history and economics tell us when we get concentration.
Well, thank you very much. I appreciate the concern that you are identifying as you talk about this concentration and what could happen if, in fact, we're not aware and make some efforts to deal with it. With that, I'm going to basically call on Mr. McHenry for his questions.
Well, thank you, Madam Chair. And Chairman Gensler, thank you for being here, and welcome back before the committee, and congratulations on your new role. I know that Acting Chair Lee, at the time of the GameStop, this GameStop trade, emphasized that the core market infrastructure is quite resilient. Does the commission intend to release any additional findings?
Thank you. Thank you for our meeting earlier this week. I look forward to doing those on some regular basis with the chair and you and the subcommittee and other members. We are looking at putting together a report. I'm only in my third week in the job, but our economists, our trading and markets folks have come together, and I think we'll be releasing a report sometime this summer that will more detail the range of activities out of the January events.
Well, thank you for that. Small businesses right now are emerging from the pandemic just like everyone is. And, these small businesses need access to capital. And as you know, I've been focused on some of the burdensome requirements of the original regulation crowdfunding, which I helped legislate, and President Obama signed into law. There have been some helpful changes made to Reg CF to make it more efficient and to boost trading in Reg A and Reg CF securities, such as preemption under certain state regulations. Do you support these streamlining efforts for small businesses, and are you looking at additional steps?
I look forward to working with you and your staff to learn more about your initiatives and suggestions, but at the core, and maybe it's just a bit because my dad had a small business, never more than 30 employees, and didn't access the broad capital markets, but I think that small business entrepreneur efforts are really kind of if I might say, a bit of the backbone of American entrepreneurism and our economies. And so access to the capital markets is a critical piece, whether it's accessing loans that might be securitized in the markets or accessing through equities. But I look forward to hearing more from you and your staff on ideas.
Okay, but no comment on Reg CF?
I again, just 3 weeks into the job, but I haven't looked closely at Reg CF yet, or frankly gotten a detailed enough briefing to see how we can, as you say, and I really do believe this, facilitate capital formation up and down the issuer spectrum.
Well, let's pivot. Let's pivot to something that you spent some time out of government understanding. I think what we've all tried to seek is greater collaboration across agencies on the regulatory framework for digital assets, cryptocurrencies, notably. This includes more engagement from industry and appropriate regulators. In 2019, the Commission staff produced the framework for investment contract analysis of digital assets. Since then, the staff has sought feedback on a number of issues, most recently on the evolving standards and the best practices for custody. This is progress, but I believe more concrete steps are necessary to further the crypto market. As you look at this issue, what steps can you outline to bring regulatory clarity so that we can have a vibrant digital asset marketplace with legitimate money and the rule of law?
Well, I thank you for asking that. And I think that this market, which is close to $2 trillion crypto asset market, is one that could benefit from greater investor protection. Within the SEC's current authorities, our authorities around securities and around products, asset managers, and products that might invest in these cryptocurrencies. So I think that, as you mentioned, we put out a comment, I think it was in October or November, asking for feedback on custody. I would hope that we would move forward and provide greater clarity around custody. I do think that working with Congress, and I think it's only Congress that could really address it, it'd be good to consider, if you would ask my thoughts, to consider whether to bring greater investor protection to the crypto exchanges. And I think if that were to be the case, because right now the exchanges trading in these crypto assets do not have a regulatory framework, either at the SEC or our sister agency, the Commodity Futures Trading Commission, that could instill greater confidence. Right now, there's not a market regulator around these crypto exchanges, and thus there's really not protection against fraud or manipulation or a conflict.
Well, I have time for one final question, Chairman Gensler. I'm encouraged by your comments on crypto. Last year, the Commission proposed to allow certain gig workers to have access to equity compensation under the SEC's rules. Will you commit to finishing this important rulemaking?
Again, in my third week, I need to get a briefing on it. I commit to work with the staff, understand what the comments were, because I don't know what comments came in, and trying to understand the economics around that rule set.
Well, thank you. And I wish you great luck in your tenure, and thank you for your testimony. Thank you for your outreach.
Thank you.
I now recognize the gentlewoman from New York, Ms. Maloney, for 5 minutes. We will go on to the gentlewoman from New York, Ms. Velasquez. The gentleman from California, Mr. Sherman, who is the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Responding to the ranking member, who wants to instill confidence in those buying and selling cryptocurrencies. The only confidence I have is that the US dollar is an outstandingly good currency, but cryptocurrencies, if they succeed, will have unique appeal to only two groups: narco-terrorists and tax evaders. And for us to channel the animal spirits that should be investing in the American economy into creating tools for those who want to evade U.S. taxes is a step toward a much weaker America. Mr. Gensler, you talked about Archegos and the total return swap. The image I have of 1929 is investors jumping out of buildings on Wall Street because they bought stock at 7, 8, 9 times margin. And in the 1930s, we decided to protect the markets and say that if you want to buy stock, the most margin you could get was 1-time margin, sometimes a little more. But we then see that using a total return swap, the big guys like Archegos can get 7 times margin, can invest only 1/7 the cash to control $100 million worth of this block of shares or that block of shares. So this raises the question, is 7-to-1 margin fine for everybody, and is that good for the markets? Should 1-time margin be the rule for everybody, and we should plug the loopholes? Or should we continue to have a system where if you're a family office, you can have 7 times margin by calling it a total return swap? And if you're the regular Robinhood investor, you can only get 1 time margin. What do we do with what should the margin rule be?
So I think you raised some very important questions that came out of the market events late in March, not the January ones, but the March events around a family office, Archegos. And they're currently, our family offices are outside of much of the SEC's remit, not all of it.
If I can clarify, this is not a question about family offices.
Okay.
You just have one investment company that has $1 billion and decides they want 7-to-1 margin. The fact this was a family office, put that aside. Whether you disclose it or you don't, whether you're a family office or a hedge fund or a billionaire, should you be able to get 7-to-1 margin? And if so, how come the Robinhood guy can't?
So I think that I've asked staff to better understand, and again, it's just the 3rd week, the rules that were adopted by the SEC that are yet to go into final implementation around the margin for these securities-based swaps and how they would have affected the circumstance. But you're right, sir, that they are different than the retail investor. And this is true across our markets. And I've asked staff to better inform me as to what we should do there.
For Mr. Cook. When it comes to disclosing short selling, there's arguments on both sides as to whether to disclose what an individual investor is doing. Some say it's harmful, some say it's helpful, but there seems to be agreement that the aggregate information is helpful. We ought to know in aggregate how many people are, how many shares of GameStop are short. You generate that information, but you don't put it on your website. I'm told that you provide it to the exchanges and they publish it if they want to, and often behind a paywall. Why doesn't FINRA disclose all this information to everybody for free as quickly as you can?
Thank you, Mr. Sherman. That's a great question. I think we are, as we look at disclosure around short selling, I think there are some good arguments that we can do more here. I've asked our staff to prepare a regulatory notice to solicit comment on changes to FINRA's disclosure here to make it more frequent and more granular. And certainly as part of that, we can look at the way in which that disclosure is disseminated.
Is there any justification for what is a regulatory agency generating this information and giving it to private companies for them to sell rather than disclose it to the public?
I'm inclined to I appreciate the gist of your question, sir, and I'm inclined to be biased towards making it publicly available. I don't understand all the history behind how this developed. I think that's something we need to look into, but I commit to that we can certainly do that.
Yeah, my time has expired, but I look forward to looking at not only payment for order flow, but how we get the best price improvement for every investor, whether it be an internalized transaction or one that goes to a market maker. I'll just say, if Citadel can't pay Robinhood, would it be different if Citadel bought Robinhood? But that's just for the record, I give back.
Thank you very much. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chairman Gensler, welcome as the new SEC chair. And I'm going to take this opportunity to veer off course a bit and mention that after years of thorough and proactive input and feedback from stakeholders, including Main Street investors, the SEC's finalized its Regulation Best, or Reg BI, is now in effect. This rule raises the standard of care for broker-dealers while preserving access and choices for Main Street investors. Chairman Gensler, under your leadership, does the SEC plan to make any amendments to Reg BI?
Thank you. Good to see you here today. As I said in my confirmation hearing, similar question came up. I think that it's important that investors actually have brokers take their best interest at heart. And that's what we're going to do through examination and enforcement, guidance, ensure that that rule is fully complied with as written.
Great. Applied as written. Glad to hear it. Thank you. Chairman Gensler, as you begin your work here at the SEC, I want to really urge you to ensure that the commission and its staff under your leadership follow its very core mission, which is, one, to protect investors, which I care deeply about here in Missouri's 2nd District, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. I want to thank you for appearing before us today, and I hope that we can work together to provide investment choice and access and affordability, I would say, to America's Main Street investors. Thank you. Mr. Bodson, is it possible that a financial transaction tax could increase financial market volatility?
Thank you, Congresswoman. FTTs are not an area of my expertise. Obviously, there have been a lot of studies done in a lot of different markets with very, very mixed results, mostly focused on whether or not they're an effective tool for raising taxes. In some markets like Hong Kong, they've been effective, but they have a very different income tax and capital gain structure, no capital gains tax. In other markets, they've shown to limit trading or subdue, so they don't have the effect that is expected. I've not seen anything discussing FTTs and volatility per se. I would not. My uneducated view would be they would be somewhat separated, but again, I have not seen any studies to indicate either way.
Aren't there more effective ways to improve our financial market operations than the bills being proposed today? Could you describe any of those, Mr. Bodson?
Well, I think the step, thank you, Congressman, the step from T2 to T1 will create a lot of efficiencies in the marketplace, both on the operational side as well as lowering the margin requirements that we impose because of the 2-day settlement versus 1-day settlement. So I think those would be steps in the right direction in terms of lowering costs, not just for our direct members, but for the end beneficiaries, be it the mutual fund, pension funds, or the small retail investor. We look to decrease costs whichever way we can.
Mr. Bodson, in your view, how would shortening the settlement cycle help prevent future trading restrictions similar to the ones imposed by Robinhood and other brokerages earlier this year?
I'm not aware of the reasons for other firms, so I'm not going to speculate about that. Robinhood did say that their decision was based on their ability to meet our margin charges. If we do lessen the time to settlement from T2 to T1, time is risk. I think that's been well explained, that by lowering the period, the amount of open transactions that we have to charge margin against would get smaller. And our estimation is the volatility charge, which is a main component, will go down by 40%. So in that sense, the capital charge against Robinhood would have been smaller. But again, it's a little bit of apples and oranges, because to say it would automatically happen without knowing the market circumstances, obviously, it's hard to say. But there would be benefit to two firms in having lower capital charges.
Some have proposed going even further than T+1 and moving to real-time trade settlement. What sort of impact do you think this would have on the market liquidity?
We are not proponents for real-time gross settlement, as you articulate. You would lose all the benefits that a clearinghouse provides, all the netting efficiencies I spoke about in terms of, trillions of trades being netted down to millions of movements, or 100 millions of trades going down to millions of movements, and trillions of dollars being netted down to billions of dollars. You would lose all that benefit. All transactions would either have to be pre-funded, and the securities would have to be on hand. So it would have a very large impact on institutional trading. It would cause liquidity issues across the marketplace. So a bridge too far in my eyes.
Thank you, Mr. Botson. My time's expired, and Madam Chairwoman, I yield.
Thank you. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Waters, for this interesting and much needed hearing. The question before us today is this: how can we on the Financial Services Committee ensure that our investors can both have access to our markets, but also are able to participate in our markets, investing safely? You see, when erroneous and inaccurate information posted on social media sites has the ability to broadly influence investors and move the market, sometimes drastically, this gentleman poses a serious question for you, our regulators. There is now such a huge hole in our regulatory process because of GameStop, with inexperienced investors relying on unverified information from unqualified social media. Mr. Cook, let me start with you. How can we effectively regulate the impact of new technology, social media sites, as they pertain to inexperienced investors? And also, how do we treat that investment advice that we're getting from unqualified people on social media? And then the real question: who is held accountable when that investment advice leads to market volatility, like we've seen, and massive losses for our investors? I'd like for the three of you, Chair Ginsler, Mr. Cook, Mr. Boston, answer this important question in the three parts that I outlined it for. This is what the American people need answers to from you, regulators. Mr. Cook, why don't you start?
Well, thank you, Congressman, for that question. I think you raised some really profound questions about where technology and other aspects of investor behavior may be going, and how does that fit within the current regulatory regime. When we talk about statements by people on social media and other places, just to be clear, FINRA doesn't regulate that environment, and we would look to the SEC in sort of understanding whether existing authorities around concepts like manipulation or providing investment advice might apply. I do think that what we are also seeing, though, at your point about retail investors making decisions without an intermediary or a financial advisor is an important one. As we see more of that happen, we are seeing a lot of that happen. I think we need to ask whether the existing regime is adequate in that regard.
Let me quickly get to Chair Ginsler. I've worked with him when he was chair of the CFTC. Chair, how do we hold somebody accountable? Answer this for me. As Mr. Cook just said, the SEC, he said, is the one responsible. How do we hold somebody? What do we do about this, Chair Gainsler?
I think you raise a good point. I know, like, probably like me, it's not about somebody's free speech rights on social media, but if somebody is trying to manipulate a market, to defraud the market through social media, and in our rapidly changing technology, it could be computers and not even humans, by the way. It could be computers communicating in. So the SEC is a cop on the beat. We're going to vigorously lean in against individuals and companies to try to assess, but we'll have to update our resources too to be able to see that relationships.
My time is coming down. How are you going to solve this? Do you feel that we can, so we don't have any more of this game stuff?
I don't know if the beeping, what, Madam Chair, I'm supposed to do because the beeping is going.
Thank you. I would expect that you would respond in writing to that question as we move on. And I'm now going to call on the gentleman from Oklahoma, Mr. Lucas, who is now recognized for 5 minutes.
Thank you, Madam Chairman. And first, congratulations, Chairman Gensler, on your confirmation. I have confidence that you'll bring the same gusto and tenacity to your role as you did as chairman of the CFTC. And I look forward to working with you. And for the benefit of our colleagues, perhaps who are not on the Ag Committee, of course, Chairman Scott, you and I spent a lot of time in a previous position, both of us, working on a variety of issues over there. So that said, this past February, Acting Chair Lee announced that the SEC will enhance its focus on climate-related disclosure for public company filings and will begin to update climate disclosure guidance. As you can imagine, the industries that are vital to Oklahoma, thinking ag and energy, are very following this topic very closely. I'll put it that way. Chairman Gensler, could you shed light on what this enhanced focus means? Does this represent a change from current SEC practices, or is this a continuation of current policy?
First, let me say thank you. I really do look forward to working with you and Chair Scott. I think we did some good work together on behalf of the American public, on behalf of agricultural interests across the country as well. So I think that if I can broaden it out a little bit, I think that disclosure is at the core of the securities laws for 90 years. Investors get to take risk, but they want to understand their risk and have disclosures from the issuing companies. And technology has changed, markets have changed. So what I'm asked the staff to do is to prepare recommendations to the commission through how we can, through notice and comment, hearing a lot of public input as to what are those disclosures in climate risk area that investors want to take into consideration in their decisions and their investment decisions. There's already, Acting Chair Lee already put out a comment period. We're going to benefit from that. And I encourage the public to weigh in and tell us what's important to them in their investment decisions and their proxy decisions and the like. And I think it actually can help an issuer to bring some consistency and comparability in this area, because there's a lot of investors that are asking for things. We can try to maybe help bring some consistency and comparability, of course, through economic analysis and vital input from the public.
I promise you, Chairman, you've gotten the attention of my constituents. And of course, how questions are asked and how the data is interpreted, they can have a dramatic effect. So with that in mind, give me a feel for what kind of a timeline we're looking at when we get to the review part of this process, where my folks can offer their insights.
Well, I hope if they wish, we could get some insight from them and input. Even there's an open comment period right now through June. We can tell you the exact date, but through June, that Acting Chair Lee had put up. But I think based on that and the economic analysis, we'll try to put a proposal together. I don't want to commit to a certain month. I'm just there for 3 weeks right now, but to try to put a proposal together and then put that out to public comment based on what we've already heard this summer. And then, that sort of starts a multi-month process after that.
Along that line, Mr. Chairman, the SEC has also created a climate and ESG task force within the Division of Enforcement to, I believe the phraseology is, develop initiatives to proactively identify ESG related misconduct. Can you visit with us for a moment about that? And do you envision that there will be enforcement actions prompted by the task force based on this new guidance, this new standard, I guess is a better way to put it?
So the task force is looking at the guidance that's already in place. So there's guidance that was put out in climate, I think in 2010. And I think that it's two things. One is to see if companies are following that 2010 guidance and following the overall important disclosure regimes that are in place at this point in time. Two is it helps us and informs the commission, all 5 of us, as we move forward to consider any future rules, because we can sort of learn from what's happening right now. The Division of Corporate Finance and the Division of Enforcement, Division of Examination, what's going on now. So one is just, are folks complying with the rules and laws that are in place? But 2, it helps inform us about some of what's going on and how we can help bring more consistency and comparability in the future.
Thank you very
Thank you,
much.
Mr. Chairman.
The gentleman from Texas, Mr. Green, who is also the chair of the subcommittee on oversight and investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. And I thank the witnesses for appearing as well. And Madam Chair, as you know, from the genesis of this process, I've been concerned about trading ahead. And you called to our attention earlier that nearly the one company, the largest market maker, executes approximately 50% of all U.S. retail volume. That's quite an amount for one firm to manage. And that causes a good deal of consternation, especially when this firm finds itself engaged in trading ahead. There are penalties associated with trading ahead, but these penalties are primarily civil penalties. And as a result of a civil penalty, many times there's no acknowledgement of liability, just a penalty paid. For example, in one case, $700,000 was paid. But that $700,000, while it seems like a lot, really isn't when we're dealing in billions, So as a result, I have been very much concerned, and I see that there is one proposed piece of legislation that would amend the Securities and Exchange Act of 1934 to prohibit trading ahead by market makers and for other purposes as well. This is something that I think has reached a point where its time has come. And I'd like to ask Chair Gensler, are you of the opinion that we should not allow trading ahead, and also that we should not allow a major firm to simply build in a penalty as simply the cost of doing business? Mr. Gensler, please.
I thank you for that question. I look forward to working with you. I think that our current rules, you're correct, are civil, but our current rules are that if you take a customer order and then trade ahead of that, that's out of bounds, not allowed. And I think that's because the customer needs to come first, and in our market structure, that's what brokers are supposed to do. I look forward to working with you and your staff on any proposed legislation. I haven't had a chance to look at that more carefully.
Thank you. The process, as Chair Gensler has indicated, is unfair to the persons who are making the purchase of in the market, who'd like to become a participant, but they don't have the advantage of the market maker. Let me ask President Batson, do you agree that this is a circumstance that we have to take a look at, because we don't want people to simply build into the cost of doing business the cost of trading ahead?
Thank you, Congressman Green. DTCC is not a direct regulator of the markets as the SEC and FINRA are. I think the situation described obviously would not be something any company would endorse, that having civil or criminal penalties viewed as a normal cost of business is not something that I think any individual should be supportive of. So your comments stand, but unfortunately, the part of the market you're talking about is trading side. That's not what we're involved in. We're post-trade, and not being a regulator, there's not much I can do about that specific issue. But thank you for asking me.
Well, thank you. And that's one of the reasons why I think legislation similar to what's being proposed is necessary, because to penalize criminally requires some creative prosecution. We don't have a definitive law that makes it a crime to do this, literally. And I'm concerned that if you can simply make it the cost of doing business, you simply continue to do business and build in that cost. This legislation would require due diligence on the part of the CEO, would require that CEO to, on an annual basis, certify that the CEO has performed a reasonable due diligence in ensuring that the market maker has not traded ahead, and have some liability when this occurs. This is something that we cannot allow to continue as simply a pat on the back to a certain extent. Some would say a slap on the wrist, but we have to do something about it. I think this legislation addresses it, and I'll look forward to working with persons who are going to push this legislation to see if we can get it done. And I'll yield back, Madam Chair.
Thank you very much. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Madam Chair. Chairman Gensler, some people believe the current short selling practices drive down share prices below fundamentals. What does your experience tell you, and what should we or could we do about it?
I thank you for asking that question. Short selling has been part of a market structure for many decades, in fact, even before the securities laws. And economists have many studies, and there have been many debates on short selling and long. Your question is could it move something to something other than fundamentals? Long buying can also move something to something other than fundamentals. And so it's not really that. Our remit at the SEC is to ensure that the markets are fair, orderly, and efficient. They're free of fraud, manipulation. But there are some times that individual securities might be, in a personal opinion, not aligned with fundamentals. But it might be sentiment is the other piece. So I just want to be careful that we stick to our important piece of it. We do think that there's a need for greater transparency in the short selling side, and I've asked staff to propose under the authorities Congress has already vested that we have greater transparency in the short selling side. I'm encouraged to hear that FINRA and Robert Cook's going to be doing some things in that area as well.
Hey, Mr. Bodson, please share with us how you're working to reduce the settlement cycle to 1 day while preserving the benefits of netting, and give us an assessment of what the savings in proposed margin funds might be.
Yes, thank you, Congressman, for that question. Shortening the settlement cycle is the concept of time equals risk. So by reducing the period that trades are open, reducing the potential impact of the default of one of our members means that we simply have to collect lower levels of margin or collateral. One of the biggest components of our calculation of margin is volatility driven, i.e. what's happening in the market, how are prices moving, and by shortening that period, we believe we can reduce that charge by 40%. in a volatile period. That could be $6 billion less capital that firms have to post with us and can use elsewhere. So it would be a significant amount for our members.
Great. Really glad to hear that. Chairman Gensler, tell us about what the SEC is doing to ensure that payment for order flow doesn't mean retail investors are subject to unfair trades.
I've asked the staff to take a close look at this in the context of the overall market structure, because payment for order flow, which some brokers use and some don't, is in essence a payment to the broker for that order flow, and it can be in conflict with the interest of that customer. And that inherent conflict we found in a case that was settled in December, where there was actually communications between the wholesaler and the broker saying, look, I can give your customer more, or I can give you more. There was a trade-off between these two. And so I think that we need to take a closer look at that, but also in the context of the overall equity market structure, because there's also payment for order flow on exchanges, which is called rebates. So there's other pieces of this puzzle, not just the wholesalers.
Thank you, Chairman. Do you believe that cooperation among retail investors in chat rooms, for example, can be undesirable collusion in the equities market?
Well, I think that we should always be vigorously enforcing our laws and ensuring that there's not fraud and manipulation. But again, we all sort of have a free speech right to go and say to a neighbor, whether it's online or in person, I like this investment, and thoughtfully say why I like this investment. Our laws are about if somebody's trying to defraud another person, mislead another person, manipulate the markets. And that we should root out and vigorously root that out, whether that's a big institution or an individual, or frankly, a computer controlled by a big institution.
Yeah. All right. During your CTFC service, you once said that transparency isn't costly. Would you explain the concept in the context of financial markets?
Did you say that I had said transparency is
isn't costly? You know, it pays to be transparent. It is.
Oh, I think transparency is at the heart of efficient markets. It does come, disclosure regimes are important for companies, and that's a form of transparency, but I think that that's at the heart of investors being able to take risk and understanding their risks.
Thank you, Mr. Chair. My time's up, and I yield back.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank both of our guests for being here. Chair Gensler, thank you for all the work you've done over the years, and I appreciate your presence here today. My great-grandpa, Reverend Noah Albert Cleaver, died in 1980. He was 103. And he used to say, you know, some new invention would come up, you know, whether it's a toaster or microwave, and he'd say, what they gonna do now? What are they gonna do now? What are they gonna do now? I mean, he was concerned. He thought that that the people landed on the moon created a bunch of weather problems, you know, in Texas. But you know that I never could get that out of his head. But so, you know, sometimes I'm tempted to join in with my grandpa on stuff. You know, I going back to Mr. Scott's discussion with you earlier, and I've got to tell you, I do have a lot of concerns, and maybe it's just something I'm going to have to learn to live with. But you know, let me give you an example. The shares in Metro Bank in the UK back in May, their shares fell over 10% before Metro could get control of the fake news about their financial freefall. I mean, you know, and you know, they are fortunate that it didn't go further. Are you? I mean, I'm extremely concerned about what's going on in regulations and what we need to do to assure that social media doesn't take control of our lives and take it in a direction that could be detrimental to our democracy. Do you share that concern? And if so, what should we do, and how do we address the issue with that was just experienced with Metro Bank?
So I think that to the best ways we can is to be technology neutral, but recognize that technologies in each generation provide us new ways to communicate. Even as when the telephone came along and there were debates whether to allow the first telephone on the floor of the New York Stock Exchange. These are real debates that happened in the 1920s. I think technologies come along in the 2020s, and we have to ensure we still stick to our principles of investor protection, fair, orderly, efficient markets, capital formation. So we've got to lean in at the SEC and learn how to basically be a cop on the beat so that free speech goes on, but if somebody's trying to manipulate a market or spoof a market or put fraudulent information into a social media channel, that we protect investors against that. And particularly in this new computer age, that's more challenging. I think the SEC is up to the challenge, but it is definitely more challenging. And I've asked the folks at the SEC, how do we freshen up our rules in this new environment?
Well, do you have a division that's a division that works on this, that thinks about this, that plans for this, that goes through all kinds of scenarios on what we do when this happens, anticipating, an anticipatory department?
No, it's, and again, I'm only in my third week, but I think between our Division of Trading and Markets, our economic unit, and our enforcement and examination, it's through those units. But I think we constantly have to be evaluating. And to an earlier question, even about regulation best interest, I said we're going to vigorously get the most out of regulation best interest, but we're also going to evaluate. I mean, if it's not serving the purpose of investors, then we will update and freshen that rule as well as other rules, because we always have to be evaluating that investors come first, align with our three-part mission.
Well, let me congratulate you on your confirmation, and I do recognize you just walked in the door, and I'm asking you some questions that you probably need a little more time to deal with. But I'm hoping that, on a night when you are about to get a peaceful night's rest, that you will remember the questions raised by Congressman Cleaver about, the markets, and become paranoid, practice paranoia with the SEC, because I am really afraid of some bad stuff happening. And I'm hoping I'm wrong, but I'm glad you're there.
Yeah.
And I look forward to you fixing this in about 6 months.
I thank you, and I wish I had met your grandfather. My mother would say that out of the space journey, the best thing that came out of it was Velcro. Gensler thought that was the best thing that came out. So there you go.
Thank you. Thank you, gentlemen, very much. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome to our witnesses. Mr. Gensler, in September of 2018, the Fed, FDIC, NCUA, OCC, and the CFPB all issued an interagency statement that clarified the differences between supervisory guidance and laws or regulations. Most notably, that supervisory guidance does not have the force and effect of law, and that the law or regulations that the law and regulations does. In January of this year, the prudential regulators issued a final rule to confirm the difference of regulations and guidance by codifying the 2018 statement. While I understand the SEC operates differently from the regulators I just mentioned in many key ways, it is still imperative that the SEC distinguishes between guidance and rule or law. Do you agree that distinguishing between guidance and rules is an essential proponent of sound regulation?
Thank you for that question, and I look forward to working with our Office of General Counsel to better understand what the bank regulators did in that circumstance. But there is a difference between rules that have gone through notice and comment and staff guidance. And that's something I'm familiar with from my prior service in government as well.
I guess you maybe answer this question here, but will you commit to issuing a final rule similar to the prudential regulators that clarifies the role of guidance and ensures enforcement actions will only be based on violations of rule or law?
Again, sir, I need to meet with staff, understand what the SEC has done in the past in this, and whether there's an appropriate need for such new rules, as you say. But I do understand there's rules as duly operating from Congress, delegated to the agencies, I understand are different than guidance, but I would look to work with you and understand your concerns better.
Very good. Thank you for that. Chairman Gensler, as you know, the Securities Act of 1933 and Securities Exchange Act of 1934 established the ability of the SEC to accept generally accepted accounting principles that have been established by a private entity. While I believe that a private standard setter can help facilitate effective accounting principles that promote transparency for investors, recent actions by FASB and an overall lack of oversight by any regulatory entity whatsoever have raised serious concerns regarding the standard setting process and FASB's ability to conduct proper analysis before finalizing a standard. In my opinion, since the SEC has given FASB the authority to operate as a private standard setter, the SEC should ensure FASB is carrying out its duties in an appropriate manner. Can you broadly tell me what you think the relationship between the SEC and FASB is and should be?
I think that Congress has been clear, as I understand it, that the securities markets benefit by disclosure, and that includes accounting disclosure, and the SEC has that authority. And then through what I believe it was in Sarbanes-Oxley, working with Senator Mike Oxley from your committee and Paul Sarbanes on the other side, put in place exactly what you said, a provision that there could be reliance on a standard setter meeting certain goals. But our Office of Chief Accountant has an important role in communicating with FASB on these important accounting standards, and that the SEC and our congressional system is at the top of that chain.
Well, my concern, quite frankly, is with their ability to implement something, like CECL, which they did not do any standard setting studies about. They just arbitrarily went out here and decided in their own wisdom that this was something that they should be doing. All the other government agencies out there that affect what we do every day, how we administer the rules and regulations every day and the laws of this country, have to go through the Administrative Procedures Act. They do not. Would you support something along the line to rein them in, so to speak, that they would fall under the Administrative Procedures Act and have to do the kind of qualitative and quantitative studies before they can issue a rule or regulation that would protect the economy, protect the industries, protect the people, consumers from a bad rule or regulation they might implement?
Well, Congressman, I'd like to best meet with you and your staff and better understand your concerns, because as I understand what Congress decided some 20 years ago in the Sarbanes-Oxley Act is that it was best to rely on and allow the SEC to rely on an outside standard setter, and that helped sort of set them apart a bit. So the concerns that you're speaking about, I'd like to better understand and see how we can address them as best we can.
I thank you for your answer, sir, and I look forward to working with you on this at length. I think it's a very serious concern there that I have with regards to these folks. With that, Madam Chair, I yield back. Thank you very much.
Thank you. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chair Lady Waters. Chairman Gensler, it's great to have you before the committee once again, and to have you as the chair of the SEC. I have a few questions. First, I want to ask you about a very important issue that I've worked on for several years, and that is forced arbitration. A few years ago, some people were pushing public companies to include forced arbitration provisions in their corporate governance documents, which would prevent their own shareholders from suing them for securities fraud in federal court. If the SEC allowed this, it would essentially be the end of all security fraud cases in federal court, and shareholders wouldn't be able to hold companies accountable in court. So I led a letter with Chair Lady Waters to then SEC Chairman Clayton, which was signed by every Democrat on this committee, strongly opposing this move, which would reverse the commission's longstanding position that such forced arbitration provisions violate federal securities law. And because this effort came so close to succeeding, I think it's very important to get you on record on this issue. So my first question is, do you believe it would violate federal securities law if a public company inserted a forced arbitration provision into its bylaws and governance documents?
It's really good to see you and work with you again.
Likewise.
I think that again, I need to get more fully briefed on the law, but let me say on the spirit and where the SEC's been. The SEC has said consistently to issuers, as I understand it, that it would be best not to put this into these corporate charters. And I think that the American public needs to be able to have redress to their courts. And that's a sort of a fundamental piece, to be able to go straight to the courts. And that's been true in terms of issuers for decades. And I think that's worked well.
Well, that's great to hear. And it's a very important signal to investors in their confidence in the U.S. capital markets. And I thank you for that position. Next, I want to talk to you about GameStop. In this committee's initial hearing on the GameStop frenzy, I questioned whether our capital markets were working for all investors or just for some investors. And I emphasized the need to have rules that are consistent, predictable, and very importantly, enforceable. What struck me the most about Robinhood's behavior regarding the GameStop frenzy was the seemingly arbitrary nature of its trading halts and the lack of transparency on the front and back ends of how and why Robinhood and other broker-dealers impose these restrictions. So Chair Gensler, not speaking specifically to Robinhood's situation, but broadly speaking, do you believe broker-dealers should improve their transparency with their customers about how and when they impose trading halts? And what role do you believe the SEC should play in improving these disclosures and ensuring trading halts are integrated into firms' risk management plans?
I think that probably what we could all agree on, that access to markets, whether you're an individual investor trading one share or a big institution, access to markets as they're moving up and down is a really critical piece of our capital markets. And what happened on January 27th and 8th was not good for millions of investors. So the transparency you mentioned is important between broker-dealers and their customers. And we've asked, and I think Robert Cook has said already that maybe they're looking at this too, is what's that transparency between and under what circumstances? And secondly, do they have, each of the broker-dealers have enough liquidity to meet their requirements with the clearinghouse, which Michael Botson was talking about earlier?
Thank you. And next, I'd like to turn to the topic of corporate board diversity. Along with Chairman Meeks, I've made fighting for women a hallmark of my time in public service, fighting for equal pay for equal work, to bring our family leave policies into the 21st century, for equal rights amendment. And I just left a hearing on maternal Black health. Mr. Meeks and I have also strongly advocated for measures to diversify the ethnic, racial, and gender composition of corporate boards and in executive ranks, because leaders set the tone and they set the priorities. From your perspective, does improving diversity on corporate boards bring a material benefit to companies?
Well, I can speak just in terms of what we're doing at the agency. And I do believe that diverse points of view, diverse backgrounds helps in decision making. And we're leaning into that in terms of building a senior leadership at the FTC.
Thank you. My time's expired.
Has expired. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And before I go into this, I would like to submit for the record a letter from the Private Investor Coalition for the record to the committee.
Without objection, such is the order.
All right, thank you. Mr. Cook, my colleague from New York was talking a little bit about arbitration and what that would mean. And I'm curious, if arbitration clauses were banned in customer contracts, do you foresee potentially negative consequences on that? And what would they potentially be?
Well, thank you for that question, Congressman Huizinga. I believe that that if the current status of these clauses in arbitration, requiring arbitration, I just want to be clear, that's not something that FINRA currently imposes. That's something that happens as a matter of contract, and FINRA doesn't have authority right now to address that. That's something that the SEC has authority to address.
No, I understand that.
Sorry, yeah.
I understand that, but FINRA does provide faster, less expensive ways to resolve disputes, correct?
Well, I think we work hard to administer an arbitration program that's fair for investors, that's prompt, that's cost effective.
I understand that. So you're not willing to say whether there would be a negative impact on that. Okay, I'm going to move on. Mr. Gensler, good to have you back, and appreciate this time. I'm going to ask you a pretty quick, simple question. Is market participation akin to gambling in a casino?
It's good to see you, and thank you for the call earlier this week. I think market participation is investing, and it takes risk, and material disclosure behind that risk is important, and a cop on the beat to protect against fraud and manipulation. So I would consider it part of our capital formation and part of risk taking.
I don't want to put words in your mouth, but I do want to be clear. So it is not gambling in a casino.
It's risk taking, and risk taking can be in different forms. But I'm trying to use my words carefully. The risk in the capital markets is something that Congress has said, let's ensure we don't have fraud and manipulation in those risk-taking markets.
Reclaiming my time, I guess. So I understand. We have some people who are trying to portray this as literally walking in and letting chance decide whether you are going to walk out a winner or a loser. That's very different than taking a calculated risk. Okay. While we're, I want to very quickly, I want to touch on BDCs and the acquired funds fees and expenses, disclosure requirements, distort the operating costs of those. And will the commission prioritize trying to fix the AFFE disclosure requirements here very shortly?
Again, maybe it's just because I'm in my third week and you used some letters that I wasn't familiar with, but
BDCs are business development companies.
Oh, I'm sorry. So I still I need to get a briefing, and I look forward to working with you and your staff to understand it better in terms of the fee disclosure that's important to our public markets.
Okay, we're happy to get you that information. I want to continue that conversation. So earlier in the hearing, you had talked regarding cryptocurrencies and crypto exchanges, that you said that, I quote, the only Congress can bring greater regulatory protection to crypto exchanges. And I'm curious, if Congress is needed for crypto exchanges, why would it not be necessary for Congress to be involved in specific regs when we're talking about the environment and social issues and governance? I mean, it seems to me that those may not be appropriate just for the SEC to be doing on its own. That does it not need congressional involvement?
I think that at the heart of our securities laws is disclosure, and that from the 1930s on, the SEC has had robust authority to ensure that investors have the disclosures that investors wish to have to make their investment. So in that regard, I do think that there's the authorities to move forward on climate and human capital and other disclosure regimes.
Reclaiming my last moments here, the acting chair Lee at one point insinuated and implied that people attack companies that say they care about climate should not donate to Republicans and should face securities liability and perhaps even SEC enforcement. I would hope that would not be the attitude of the SEC moving forward. With that, I yield back, and I look forward to continuing the conversation.
Thank you.
Thank you very much. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the subcommittee on consumer protection and financial institutions, is now recognized for 5 minutes.
Thanks, Madam Chair. Good to see you all. I have two specific questions I want to start with. One involves delisting what would be, penny stocks, if you will. And the second involves diversity and inclusion, then get into some general questions. So, Mr. Gensler, back in 2005, in response to changing market structure and then new technology, SEC adopted amendments to the penny stock rule that, among other things, requires a stock to have a minimum bid price of $4 a share to initially be listed on a national exchange. And additionally, the SEC has classified penny stocks as securities trading with a value of less than $5. GameStop's stock traded under $4 back in through 2019, and then hovered between 4 and 5 throughout 2020 till the end of 2020, when it began to tick up and then went skyrocketing starting mid-January. And so Colorado, we used to be the penny stock capital of the world, and a lot of abuses occurred during that time frame. Would you agree with my concerns about the potential to manipulate low-price stocks?
Yes, there's been a long history. The lower the price, and also the lower the aggregate market value, the fraudsters find that more appealing. The fraudster does. And in fact, earlier this year, the SEC took actions to delist, I think it was about 30 entities that fell into these various categories.
All right, with so many more retail investors coming to the market through mass platforms like Reddit and other ways, do you think it would be timely for the commission to examine whether the rules around penny stocks, including exchange listing standards for these stocks, needs to be updated?
I think you raise a very good set of concerns, and now I've got some more work to ask the staff to look at, but just what are the current rules? How did they affect what happened in the spring or late winter? And even how it relates to, broader subjects in the market.
All right, thanks. So my second question, and primarily goes to you, Mr. Gensler, and it's a follow-on from Ms. Maloney's diversity questions. And it's a question that was raised to me by a friend of mine, so I'm going to ask it just as he presented it to me. When you were chair of the CFTC, you did not have any Black division directors at that agency. Will you commit to doing better on this point in your current role at the SEC?
Well, I just not to fuss with your friend, but I actually hired the first chief operating officer as African American in the history of the CFTC, who's done just a terrific job. He's still there, by the way.
All right, good.
So, but yes, the answer is yes, sir.
Okay, thank you. To all of you, I am perplexed by this whole GameStop thing. I mean, in 19 and 20, it was at $4. January 7th, it was at 17. January 27th, it was at 347. And February 9th, it was at 50. And now it's bouncing around at around 162. So, I'm concerned about the mass platform and the potential for hyping a stock in that way. I'm concerned about the unfair advantage in order flow. And I'm concerned about the potential harm from short sales. So, Mr. Cook, I'll start with you. If you were to look at those three things, Which one bothers you the most? Or do any of them?
I think those are all important areas of concern. We are looking at all those areas. I think the one that I think is novel at the moment and requires our real attention, and we look forward to working with the SEC on this, is the expanded use of online trading platforms, which again can really create better access to our markets and be very good for investors. But how do we make sure that at the same time they're being protected, and that we're making sure that, especially as they may go towards complex products, that is being properly overseen?
I think I'd like to talk about the dropping down to T1. Do you think that takes some of the potential for fraud out of the system? Mr. Cook?
I think that while we fully support reducing the settlement cycle, I'm not sure that in of itself is going to address those types of concerns that you raised. I think it may be a different set of issues.
All right, thanks, Madam Chair. I yield back.
Thank you. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate this hearing, especially these witnesses who I think bring a great deal of expertise to the topic. Let me start with Mr. Bodson on GameStop specifically. As you noted in your testimony, the temporary restrictions on trading by Robinhood and others were due to the additional collateral required by the DTCC. But those were extraordinary circumstances in an exceptionally volatile market. For the sake of retail investors, of course, we don't want to see, generally speaking, halts in trading to happen frequently or ever again. I do appreciate your testimony that moving to an accelerated settlement could reduce margin requirements and specifically bar charges by up to 40% if we go to T+1. But can you describe how DTCC communicates with brokers regarding their collateral requirements? And specifically, are there ways to improve that communication or otherwise increase transparency to mitigate the risk of repeating this kind of surprise margin call and what happened in January?
Thank you, Congressman. Our process for computing the margin and communicating such is laid out in our rules, which include the margin formula itself. There are margin guides. We have a portal that they can use to estimate their margin. You know, the calculation works overnight. It's every day. It's run at the end of the trading day. It takes into consideration market volatility. It looks at specific security volatility, concentration of activity in certain securities. So what you saw in GameStop was almost a perfect storm going through these retail platforms where a lot of buy activity, massive buy activity, 130 times normal volume we saw weeks before, in stocks that were moving around anywhere from 100 to 300% a day, and just highly volatile over this period of time. So the margin calculation reflects the risk that the firm is presenting to us. That calculation is done overnight, and it is communicated the next day automatically by email generation. In the case of Robinhood, there was an additional charge, a capital premium, which was as a result of the fact that their margin requirement was in excess of their net capital, indicating that they were taking on more financial risk than we felt would be prudent. That charge was later waived, but the core margin charge of $1.4 billion, again, it's articulated in our rules. We give the client a tool. Transparency is always a good that we'll always try to get better at, but we believe that we do provide those tools.
Thank you very much. Moving to Chairman Gensler, congratulations on your confirmation. Look forward to working with you, sir. And let me just revisit a question that Mr. Luxmeyer and also Mr. Lucas asked and kind of bring them together. The regulation by enforcement question from Mr. Luxmeyer and the ESG disclosure question from Mr. Lucas. We don't want to see regulation by enforcement. We want to see notice and comment rulemaking wherever possible. On March 4th, the SEC announced its new enforcement task force focused on climate, as was discussed earlier, and ESG issues. But it wasn't until March 15th that it issued a request for public comment. And the SEC has not completed its recently announced review of the 2010 guidance Chairman Gensler, can you explain the sequence? In other words, why is the announcement of a new focus on enforcement coming before market participants know the rules? And will you commit to adhering to requirements under the Administrative Procedures Act and completing notice and comment rulemaking prior to engagement in any enforcement action?
So I am committed to complying with the Administrative Procedure Act on rulemaking, and I have said in this hearing and in my confirmation process, I think the market investors do want to bring some consistency and comparability to climate disclosure, human capital disclosure, and moving out and getting that comment. But there are rules of the road that are already in place. The guidance from 2010, our overall securities laws, and we're going to be vigorously enforcing the laws and rules that are in place as they're in place. But yes, I'm committed to using notice and comment for new rules, but we still have to enforce the old guidance and old rules as vigorously as you would want us to.
Well, thank you. And I don't have time for this question, but I'm going to be talking to you about horse racing, Chairman Gensler. I represent the horse industry in Kentucky, and we've got a Reg A problem. We want to democratize ownership of securities and race horses, and we look forward to working with you and the commission on that issue.
I look forward to that. A different issue than GameStop.
That's right, and we just finished the Kentucky Derby, so it's a timely issue.
Correct.
Yield back.
Thank you very much. The gentleman from Connecticut, Mr. Himes, who is also the chair of the subcommittee on national security, international development, and monetary policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our witnesses. It's a real pleasure for me to see all three of you before the committee. To the chairman, Mr. Cook, I'm glad you're our cops on the beat. You've in your careers and today distinguished yourself for your balanced approach and really intelligent approach to the issues. And Mr. Bodson, it's great to see you. Kudos to you when the chant from both ends of the political spectrum was let them trade. Kudos to you for pointing out that the trading stops were actually part of the system architecture designed to keep disaster and catastrophe from happening. We don't let airplanes fly in horrible thunderstorms, and there will be times when we need to just stop and pause the markets for prudential reasons. I want to reflect on a lot of thought on GameStop. There's been a lot said. And as usual, we've sort of devolved into a little bit of a silly partisan conversation on the topic. We ought to be able to agree, as I think we do, that investing is a critical part of asset accumulation for American families. We ought to be able to agree, I have a little problem with my good friend Mr. Hazenga on this, that investing done irresponsibly, that is to say without research, without thought around companies that you don't know about, will in fact result in a return that begins to look a little bit like the return you will assuredly receive in a casino or on the horse track. So I think our objective is how do we maximize the former, good, smart investing, and maybe encourage or discourage the latter, that is to say investing that actually ends up hurting retail investors. And the facts are pretty clear on what behavior leads to them being hurt. This is a question for Mr. Gensler and Mr. Cook. Having really looked at what happened with GameStop, I'm satisfied that the market will fix itself in the sense that when we do return to a bear market, some people are going to learn some fairly expensive lessons about the fact that the stock market is a risky place to put your money, and that'll all be good. Where I get concerned, though, is when you start talking about a lot of complexity and in particular leverage. So margin. Option strategies that I'm really pretty certain that most of us, much less the average retail investor, doesn't understand. My question, I guess, for Mr. Cook and Mr. Gensler is there a point where you're employing leverage or synthetic leverage through margin or through derivatives that we should begin to think about restricting the ability of retail investors to employ those strategies? I don't need to remind the committee that we all know the story of Mr. Alex Kearns, who took his own life because he traded in some fairly complicated option strategies and discovered that he had created a liability for himself that he'd not anticipated. So my question is is there a line around leverage or complexity where we ought to not let the market teach tough lessons?
So I'll go first, and I'm sure Robert will want to add. I do think that our core is protecting investors, and for a long time we've said to open an options account, there was more discussion between a broker and that customer. Suitability used to be the words of the art, but and if I've got the words wrong, I apologize in my third week. But basically, they're taking more risk. I would also add, in terms of these apps, these applications that have made it easier to open accounts, in making it easier, we've lost that human in the middle saying, wait, is this appropriate? Is this risk appropriate? The thing that is like those buildings in Las Vegas and Atlantic City is that through gamification, they're using psychological prompts and behavioral prompts to get investors to trade more. And trading more, economic studies show, doesn't necessarily mean getting better returns. And so I wanted to add that, if I could, Congressman Himes. But I know Robert wants to answer.
Yeah, thank you, Mr. Cook. Do you have anything to add to that?
Well, thank you for that question. I do think it's a matter of striking the right balance because, as you say, there are lots of risks that people may be taking on through complex products, margin, and we do have rules around some of that. There are limits on how much margin you can take. There are special requirements to open up an options account. But I think many of these rules were developed at a time when the only way you would do that was if you had a broker or an investment advisor, someone advising you and understanding the risks that might be appropriate for you. And so in light of that, in light of the fact that many of these same products are now available directly without some intermediation, we need to think about whether the existing rules should reflect the change in the technology.
Thank you very much. I yield back the balance of my time.
Thank you very much. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair. And this is the third hearing on the GameStop saga. And one of the overarching themes has been protecting retail investors. I'm completely in agreement with the need to do this and ensure that everyone, no matter how much money they have invested, is competing on an equal playing field. However, one of the policy proposals that's being discussed to pay for some of the Democrats' progressive priorities would be determined to these same investors detrimental to the investors we're trying to protect. Of course, I'm speaking on the financial transaction tax. Contrary to what some on the left may want you to think, implementing this new tax would not only affect hedge funds and wealthy individuals, but rather anyone with a 401k or who opened their own brokerage account to trade stocks in their free time. So, Mr. Boydson, can you give us your thoughts on the most likely changes we will see if financial transaction tax is imposed?
Thank you, Congressman. Again, I'm not going to claim expertise in FTT, but the studies we have seen show mixed results. In some instances, it did slow down trading. It did dampen levels of market activity. Hong Kong is the contrary one, but again, Hong Kong has a low income tax, no capital gains tax, so very different circumstances. And the question you raise is exactly how does the tax get paid? Who ends up paying it? In many cases, it will flow, as you said, right back to the end investor, so the retail investors, the pension funds, the mutual funds. And if that's the case, then that would obviously impact returns negatively and impact the wealth creation that one would want to see in the stock market.
Okay. Raising taxes does not help, I'll tell you. Chairman Gensler, first of all, congratulations to you, and I want to welcome you to your first hearing before this committee. I hope we will have a productive working relationship as you take on this important role. And I want to start by asking you about transparency. We've used that today during the rulemaking process. For market participants, certainty is the key, and there needs to be a clear roadmap on what the SEC is focusing their attention on. So, Mr. Chairman, what steps do you plan on taking to ensure the public is informed about the priorities and regulatory agenda that the SEC is undertaking during your tenure?
I look forward to working with you, Congressman Williams, as well. I think that the transparency of our regulatory agenda, along with the rest of the administration, we would be publishing, I think it's twice a year, a unified agenda that's required under the law to publish our agenda. But it's through hearings like this and talking with the public more broadly about the agenda, about disclosure, market structure, ensuring that the markets work for working families.
Well, thank you for that. Our capital markets are extremely regulated. No single entity, whether it be an exchange or a broker dealer or SRO, that acts unilaterally without any oversight. As we are discussing broad changes to our capital markets, we must find or first ensure we all have an understanding about how all the different players interact within the ecosystem. So, Mr. Boydson, for you, can you discuss quickly how the DTCC communicates and it's overseen by the SEC as you are setting margin requirements, as well as how you give notice to your clearinghouse members?
Thank you, Congressman. All our margin requirements are reviewed and approved by the SEC. They are subject to public commentary, so if we are introducing any change to the margin rules, there will be a period of time where other members or anybody else that's interested can make a comment, and then the SEC approves it. The models are subject to very vigorous reviews internally by our risk departments, our audit departments. They're reviewed by the board. So we have a very rigorous governance and regulatory oversight of all our models.
Okay. I want to thank all of you for participating. Madam Chair, I yield my time back.
Thank you very much. The gentleman from New York, Mr. Meeks, who is the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you very much for this timely hearing. And I want to thank our witnesses today, both Chair Gensler and Mr. Cook. Chair Gensler, during these market volatility hearings, ensuring markets are fair and transparent so that investors are well informed has been a focus. Transparency is particularly important where investors are seeking information on the demographic makeup of company boards. In 2009, the SEC adopted its current board diversity rule to shine light on the demographics of corporate boards. However, the results of the current rule have been vague and abstract disclosures, as indicated by former Commissioner Louis Aguilar and former Chair Mary Jo White. In fact, an advisory committee at the SEC recommended in 2017 more specific disclosures around race, gender, ethnicity, because of the current rule's deficiencies. Those recommendations were not adopted by your predecessor. So my question to you is, first, can you commit today to revisiting the SEC's board diversity rule and requiring more specific disclosures around race, gender, and ethnicity as recommended by the SEC's Advisory Committee on Small and Emerging Companies in 2017?
I thank you, Congressman. I look forward to working with you, or should I call you Mr. Chair? And I do think I've asked staff to make recommendations up on how we can do what you've suggested in terms of that investors are increasingly want to understand these particular issues around diversity and more broadly human capital, both. And it's driven by what investors want to see, and I've asked staff to try to serve up some suggestions on this.
Well, thank you. You know, also, I don't know, I would hope that you could also think of maybe other initiatives that you can consider or encourage, you know, others within the department to have greater diversity in both corporate America and at the SEC itself. So I don't know if you have any additional thoughts on that, but if you don't, you know.
I've also we have 4,400 people at the agency, but we also have a number of outside advisory groups, and as those terms roll, they're on rolling terms and everything. We've also asked the staff to look to ensure that those committees reflect the great diversity in our nation.
Well, thank you for that, and I look forward to working with you to work on this particular issue. Let me go to Mr. Cook right quick for the time I have left. You know, Mr. Cook, this committee has examined inherent conflicts of interest with payment for order flow that can be difficult to mitigate and adequately protect investors. For example, brokers can often be incentivized to route customer orders to a highest bidder instead of to another trading venues or other better prices. Despite disclosures, investors may not entirely be aware of how payment for order flow affects their pricing or whether they are getting the best execution. FINRA requires that any transaction should be brought and sold in a market in which the resulting price to the customer is as favorable as possible under the market conditions. So, Mr. Cook, how can FINRA ensure that firms are always meeting their best execution obligations to their customers where the firm uses payment for order flow?
Well, thank you for that question, Congressman. You're absolutely right. Our rules do require best execution by both the firm that's routing the order and by the firm that's executing the order. And payment for order flow does create a conflict that does complicate that because, of course, we have to evaluate, is the order flow being routed because of the payment or because that's where the best execution is available? And that's an analysis that we work on every day through our oversight and surveillance, through our examination, and through guidance. I think we look forward to working with Chair Gensler, who has indicated he's going to be asking his staff to take a fresh look at this, because I think fundamentally the question is that conflict that you're describing, is it adequately addressed through disclosure? And also, what disclosure are retail investors really getting, and is it something that they understand? I think many investors really don't understand these aspects of the market. We need to think about, are there better ways we can help make sure they understand how their orders are being routed?
Thank you very much. I see my time is about to expire. Thank you, Madam Chair, for holding this hearing.
You're so welcome. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes. Mr. Hill? If Mr. Hill is not on the platform.
I'm sorry, Madam Chair.
Are you there?
Yes, I am. Thank you.
Please, you're recognized for 5 minutes.
Thank you so much. Well, this was a good hearing. I like part 3 as much as I like parts 1 and 2. Thank you, Madam Chairman. Thank you for our panelists. Let me start with Robert Cook. Robert, in the first 2 hearings, we talked a lot about Robinhood and other app-based broker-dealers versus a traditional retail-facing broker-dealer. And it was clear to me that customer service access for clients of Robinhood seemed to be lacking. I talked a little bit about sales practices in the area of small dollar stocks or options. What have you looked into this, and what are your views here, Robert Cook?
Well, thank you, Congressman Hill, for that question. Without speaking about any particular firm, it is an area that we're taking a look at. You'd mentioned customer service. We do expect firms to have sufficient infrastructure to comply with our obligation that they capture, acknowledge, and respond to customer complaints. We don't particularly require, for example, a live customer service agent. We provide flexibility for how that's done. But basically, traditionally, it wasn't thought necessary to regulate how firms provide customer service. And the expectation was they knew how to be responsive to their customers without regulators telling them how to do so. But financial services sector is evolving, as you know, just like the rest of the world, and commerce online, and lots of businesses don't have 800 numbers. So as we work with the SEC to review these events, that's one of the things we'll consider, whether there might be additional guidance going forward about kind of what are the minimum levels of support customers might need.
Well, thank you for that. Chairman Gensler, congratulations. Delighted to have you back in the regulatory leadership space. My question for you, sir, is are you familiar with the task force on climate-related disclosures that was led by former Mayor Mike Bloomberg?
Yes, sir, I am. It's good to see you again.
My pleasure. Have you read that yet, or had a chance to study its the sort of executive summary of it?
I've had an opportunity to take a look at it during my confirmation process, and I've just been yet to sort of dig into it with the career staff at the SEC.
Right. Well, I noted in your comment before a confirmation hearing, the Senate Banking, that you believe that companies obviously are required to disclose material things, and you made a statement that companies have a legal obligation to determine what's material. Do you think companies have any obligation to disclose non-material risks regarding any topic?
I think that the heart of our disclosure regimes over multiple decades is that which investors are looking for. Investors to make their decisions. And we have regimes from accounting regimes, management discussion and analysis to employment compensation, that those regimes are that which investors need to pick up on and make their decisions on.
But you believe that public companies should be based on materiality in their disclosures.
There is a materiality component of disclosures, but there are also individual disclosures that are often very small, but still can have a really meaningful part to
about it.
Yeah. All that would be necessary is an agreement on what the algorithm you're running in the time window to establish the reference price. And it doesn't have to be the best algorithm. It has to be a standard one that pretty well reflects the price that they should have gotten and allows an apples to apples comparison of the apps.
Thank you. The gentleman's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Chairman Gensler, I'd like to switch topics a little bit with you and discuss the SEC's consolidated audit trail. Now, when I was in the military, I was in a position in intelligence where I was responsible to protect a lot of highly sensitive data. And we had one principle that we lived by, and that principle was you don't have to protect what you don't have. And if you don't absolutely need something, especially if you have access to get it in other means, do not keep it. Now that's a basic rule of cybersecurity, that you can't disclose something that if you don't actually have it. Now, as you know, the consolidated audit trail is expected to collect 60 billion records every day of trading in the equities and options market. In July of next year, brokers will be required to report the personally identifiable information of every retail investor to the consolidated audit trail. While there are certainly times when the SEC needs to access investor data, this massive database will be a major target for cyber criminals. That's why I propose legislation that will require the SEC to instead obtain this data by requesting it from the broker and make sure the SEC is able to quickly access the data it needs. Brokers would have to provide that data to the SEC within 24 hours. So, Chairman Gensler, a 2018 poll indicated that 89% of retail investors oppose having their personal data collected in the consolidated audit trail. And that's why I proposed decentralizing this data across thousands of different brokerage firms instead of just one giant database, which is much, when it's all consolidated, it is a primary target. My question is, will you take action to protect the investors' sensitive personal data?
Congressman, I thank you for asking that. And the SEC is committed to protecting data. I think also, just as an update, and I believe this was late last year under Chairman Clayton's leadership at the SEC passed some updates to the consolidated audit trail provisioning that a lot of that personal information that was going to be collected no longer will. People's birthdays, people's social security numbers and the like. And it might be that Mr. Cook has more details because it's really under FINRA that the consolidated audit trail project is being put together. But I concur. I think a lot of that personal information is now not going to be collected, sir.
Well, that's a good start. But again, the basics of cybersecurity and protecting data is if you have access to get that data somewhere, and data is always more secure when it is dispersed in multiple locations. That's why a lot of companies are going to new technologies that the blockchain technology, which disperses that data. It's much more protected than when it's centralized. And even if you don't have PII, if you have a certain amount of information that can close the loop from other information, it puts a lot of people at risk. And so I think it is vitally important that we protect investors' data from unnecessary risk. And I hope that you will take efforts to address this to make sure that people's information is protected. Because as we know, the federal government has shown to be one of the targets and has disclosed a lot of information in the past. And so on another topic, as I stated in the first hearing on GameStop issue in February, it's unfortunate that some of my colleagues are using this issue to call for a laundry list of new regulations. But beyond just calling for the new regulations, they're actually proposing them in this hearing. Many of these proposals are a solution actually in search of a problem. So, Mr. Cook, if Congress was to ban payment for order flow, what effect would that have on the availability of commission-free trading for the everyday investor?
Well, thank you for that question, sir. I think a ban on payment for order flow, the impact would vary significantly across different firms based on their business models. There are some firms who don't accept payment for order flow now and still charge zero commissions, but there are others who rely heavily on it. And one of the things to think about, if you're thinking about banning payment for order flow, would be what would be the pass-through effects on investors. Payment for order flow also does have some advantages that have been identified by the SEC in the past, including the potential for guaranteed execution with some price improvement or prompt execution. But I think this is a very complicated area. I think if the Congress or the SEC were to think about banning, we'd have to think about all the knock-on effects throughout the market structure system.
Thank you for that.
Thank you very much. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Madam Chair. I want to thank you again for holding not only this hearing, but the 3 hearings. I think it was very important for us to really take a look at what happened at GameStop. The only thing I would ask, Madam Chair, is please don't scare Mr. French again. He seemed to be very frightened at some point, and I would just ask you to be a little more delicate with him.
I assure you it was not me. Thank you.
He's a good friend to many of us, so please. I know, I was teasing. I do want to thank the witnesses for being here. Again, I appreciate it very much. I was going to ask about the 2 things, the shortening the settlement cycle, the T1, and really if their savings are 40%, and also about market concentration. However, Mr. Lucas first opened the door to ESG, and then Mr. Huizinga kind of kicked it open, and then, of course, Mr. Hill smashed it open. So I have to say that I'm very interested in ESG myself, and I want to ask a few questions about that. Chair Gensler, I don't want to put words in your mouth. I noticed that others tried and they weren't very successful, so I'm not going to do that. But I do want to say this. A very wise man once said, transparency is at the heart of efficient markets. And the same very wise man said, at the heart of our laws are disclosures. Even though you've only been there for 3 weeks, Chair Gensler, I think you know the man who said that. Because of course you just did a little while ago. And I have a bill, and my bill, HR 1187, which passed out of the committee. Among other things, it would establish a sustainable financial advisory committee to communicate with interest groups and individuals regarding sustainable finance, and ultimately provide the SEC with a report identifying policy changes that could facilitate sustainable investments. In addition, the bill requires this committee to submit recommendations to the SEC regarding what ESG metrics and the SEC should require to be disclosed. As you know, many companies already disclose ESG metrics, and I think it's very unfair that some do and some don't. I'm curious to know your words without putting words in your own mouth. What do you have to say about that, Mr. Chair?
Well, I look forward to looking closely at your bill and talking to your staff about that. But I think that to the extent the broad public is listening to this, please give us comments, even now in an open comment period. It'd be really helpful to understand as investors what you think you need and wish, and you're making your investment decision, your proxy votes and the like, on climate, on human capital, on diversity and the issues that we've been talking about here in this hearing, or other disclosures. And it's really helpful for the agency as we're doing this. I think consistency and comparability are helpful as well. And right now, a lot of issuers are dealing with varying needs around this issue and around the globe, because our companies here, we have to look out to US investors, but our companies are also trying to raise money overseas or operate overseas. And there's a bit of an alphabet soup of different approaches to this. So I think it's important. It's within the authority and mission of the SEC to enhance this disclosure and bring some consistency and comparability to it.
Well, that's music to my ears. What I would also add, and I think you've already stated it, but materiality, when they take a look at materiality, it's the investor that gets to decide that, not the company. I think it's very, very important that the investors know this information. But again, I'll put that aside because I know my time is running out. But I did want to ask you about the T+1, Chair Gensler. What do you think? Is there really all that savings, 40% savings there? And if that's the case, why not real-time settlement? We heard that that's probably impossible to do.
So I think technology exists to come to same-day settlement. There are real savings, lower costs, and lower risk. The question about same-day settlement is it's still netted, as Mr. Botson pointed out. Netting is a really important piece of the economics, but you could have same-day evening, so to speak, and have it all netted. But there are obviously transition costs. Moving from T+5 to 3 to 2 took time. I note in the 1920s, we were at T+1. So getting back to T+1 100 years later in modern technology, Mike Botson's writing this down. He's saying, oh no. But I want to say that we can get to T+1, we could get to T plus evening, but it will take some time.
Thank you.
Thank you. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. I thank our witnesses for lengthy testimony today. It certainly adds value. Each of our three witnesses contributes important roles to ensuring our capital markets operate efficiently and effectively. And I thank each of you for taking such important responsibility. The market volatility we saw. The market volatility we saw in January has more people talking about the clearing and settlement cycle. And during the first GameStop hearing, I highlighted some projects that the DTCC was working on regarding the use of distributed ledger technology to shorten the settlement cycle and enhance our capital market structure. Mr. Bodson, I want to personally thank you and your team for sending me an update on those projects, and I look forward to monitoring their progress. Speaking of distributed ledger technology or blockchain more broadly, I would like to hear Mr. Gensler's thoughts. It is well known that you are a blockchain expert, as evident by your time as a professor at MIT. There are some fascinating videos on YouTube where you're teaching on the subject. If anyone has time and wants to learn more about blockchain technology, I want to get your views on regulation of digital assets. Since 2017, this topic has been a passion of mine, and I've set out a legislative goal of creating a bipartisan and clear, light touch regulatory framework for digital assets that promotes innovation while protecting consumers. The final product was the Token Taxonomy Act, first introduced in 2018 and reintroduced last Congress and now this Congress. It has bipartisan support and always has. The bill has had input from academics at Wharton School of Business, trade groups like the U.S. Chamber, specialized groups such as the Blockchain Association, various state regulators, and plenty of market participants. In 2019, you told me, Chairman Gensler, that the SEC has been slower than I think we want, quote, in terms of creating a regulatory framework for digital assets. Just 2 days ago, Secretary Yellen publicly stated that we do not have adequate framework to deal with cryptocurrencies from a regulatory standpoint. Now, with you at the helm of this agency, I think it's an opportune time for the SEC to work with Congress on creating this regulatory framework that's bipartisan and clear. Chairman Gensler, have your views changed since 2019 on the SEC's approach to digital asset regulation?
Congressman, thank you, and for that personal shout out. It's a free course, by the way. It's free online. But I think that there are things that we can do better and get done at the Securities and Exchange Commission, and we have authorities. But I also look forward to working with Congress if it's the desire of Congress to try to fill some gaps. As I said earlier, I think crypto exchanges, particularly if one trades Bitcoin in America today, there's not a investor protection regime that really protects as I think would be appropriate around these exchanges. So I look forward to working with you and in this committee, if the chair wishes so, on anything you would do in this area.
Thank you so much. And I look forward to working with you. And frankly, our bipartisan group will certainly as well. Regulation by enforcement's been characteristic of this space. Obviously, XRP is a key case, but it'd be great to have a bright line test so that we wouldn't be dependent on so many enforcement actions or no action letters. So greatly appreciated. Lastly, I do want to talk about the SEC's authority to suspend trading. I look forward to working with you on a bill that would provide additional transparency about why the trading was suspended, and more specifics there. And some of that has already been commented on by others. But I'd leave you the opportunity, sir, to any closing comments on that kind of transparency.
I look forward to hearing more about the issue. As you said, I haven't looked at your bill, and whether you're talking about suspending penny stocks or was it suspending others, because there's small market cap companies that are in some cases have no products and no employees even, but that just are ripe for fraud and manipulation. There's been a regime for decades around penny stocks and trying to protect the public from what are easily manipulated circumstances.
Yeah, just like that clarity that you had there, that's the piece that when you put the disclosure out for information flowing, what information triggered the halt. But I look forward to it. And Madam Chairwoman, thanks again for the hearing. I yield back.
Thank you. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you to our witnesses for being here today. Chairman Gensler, congratulations on your confirmation to lead the SEC, and welcome to the House Financial Services Committee. It's good to see you, and I know we're all looking forward to working with you in the coming years. I'm helping to lead a bipartisan effort to reinstate the state level tax deduction that was eliminated in the tax hike bill of 2017. Capping the SALT deduction has enormously increased the tax burden on hardworking middle-class families in New Jersey's 5th District. To make matters worse, some legislators now want to impose a financial transaction tax, an FTT, on stock and bond transactions, including in my state. Chairman Gensler, according to a study by Vanguard, an FTT would cost retirement savers $36,000, more than 3.5 years of savings over their lifetime, and would send jobs and markets overseas. Mr. Chairman, first, do you support a financial transaction tax?
First, let me say it's good to see you. We full disclosure, we first knew each other maybe 20-some years ago working in administration. I really think that I would leave it to Congress and the executive branch to sort through taxes. And our remit at the SEC is about ensuring that working families are protected, we protect them, and we have fair, orderly, efficient markets and capital formation. And the taxing questions are really outside our jurisdiction, if that's all right, Congressman.
I appreciate that. And yes, and I'm excited to work together again. Can I maybe just ask it a slightly different way? Maybe that'll let you answer under the remit of the SEC. Are you concerned about an impact it would have on the markets, on pushing markets overseas if we did any kind of new levy? There's a lot of concern that it's so easy, given technology, to move the back end of these processors overseas, which is kind of what we were facing in New Jersey. From a market perspective, would you be concerned about that, or would you prefer to?
Again, I think what you're raising is there are trade-offs that I think were more appropriately made by Congress and the executive branch in terms of those trade-offs. We do have a modest fee. It funds the agency. It's about $2 billion a year that we've had. So, but whatever trade-offs beyond that, I think I'd leave to the White House, Treasury, and Congress.
Thank you, sir. Separately, if I can ask you about investment broker-dealers are, as you know, legally required to offer best execution for their clients and to provide the most advantageous order execution for their customers, given the prevailing market environment. However, as you know, there's a perception that the practice of payment for order flow creates a conflict of interest between brokers and the investors they serve. Do you believe that payment for order flow presents a conflict of interest too significant to be adequately addressed by regulations such as enhanced disclosures or strengthening best execution obligations?
So you raise a good question, because we found conflicts in various enforcement cases, like one that we followed in September, where the wholesaler was literally saying, well, you tell me, I can pay you more to the broker, I can pay the customer more. So we know, at least from that case, this inherent conflict is there, and whether we can address it enough through disclosure, or it sort of implicates the broader market structure. And I've asked staff to think about that broader market structure, and not just the wholesaler payment for order flow, but also the exchanges through rebates, and just how's this market structure that's led to concentration. So right now we have a pretty highly concentrated and growing concentration in the retail order flow. Economics tells us competition lowers costs to investors.
Well, I appreciate that, and I really appreciate that you're hopefully going to get input from stakeholders before taking any action, and I like that you're asking the SEC to do so. Lastly, as Warren was saying, and building on your professorial acuity in the cryptocurrency space, and by the way, I've really enjoyed our conversations on this, because I think it's wonderful to have somebody with your level of expertise at the SEC, given the competitive marketplace, and I think it's really important that we take the lead here and not cede the lead to others in the world on fintech and cryptocurrency. Markets continue to grow and innovate. I would hope, and I think I know the answer to this, but commit to providing clarity for market participants in the crypto space and working with stakeholders to ensure that we don't lose our nation's place as the #1 country for innovation and technology. Just making sure that it's that clarity that I think is so important.
Congressman, I can't agree. Our capital markets for decades have been part of our economic success story. And technology comes along, markets change, but we want to make sure we enhance our rules and get ahead of this in the crypto space as well as in the traditional security space, and always refresh our rules.
Thank you. I yield back. Thank you so much. Good to see you.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
Thank you, Chairwoman. And Chairman Gensler, welcome and congrats on your new role. Following up on the crypto conversation, in all my conversations with crypto industry leaders, they mentioned a lot of the same priorities: the need for a coherent, clear regulatory framework, clarity for legacy institutions to offer DeFi products, and even regulatory steps to offer a Bitcoin ETF. But the U.S.'s lack of clear guidance is both a competitive disadvantage and it's a national security concern. So as you know, this is a complex issue, but I hope you're going to be willing to work with Congress as we talk about some of the steps to be taken. So there's a strong group of bipartisan lawmakers and regulators that want to help solve the issue, but I'd just like to turn it back over to you and see what would you like to work with in this area in regards to blockchain and cryptocurrencies. And I appreciate the other members coming before this that have mentioned cryptocurrencies and blockchain.
I thank you. I look forward to working with you and any member of this committee and your staffs. I think that there's a lot of authority that the SEC currently has in the security space, and there are a number of cryptocurrencies that fall within that jurisdiction. But there are some areas, particularly Bitcoin trading and large exchanges, that the public is not currently really protected on these crypto exchanges trading just Bitcoin. And so that would be one area I would highlight.
Very good. Second question is the GameStop episode, switching back to actually talking about GameStop, it highlighted the need to revisit settlement times. So it's understandable that any move away from T2 will need full industry support, but the struggle of moving from T2 to T0 settlement times, it's not lost on me. So Chairman, with today's state of technology, including blockchain technology, what is the SEC and the DTCC, and also want to include Mr. Bodson in this, what are you all doing to evaluate the potential use of blockchain to help speed up settlements? And I'll start with you, Chairman Gensler.
So you're right that technology exists today to shorten settlement cycles, even maybe to the same day. I think there's a business model issue as to whether it's still netted, which has a lot of economic advantages. In terms of the underlying ledger technology itself, I would defer to Mr. Bodson as to whether they find it's helpful to have a distributed shared ledger or sort of a single party ledger. And then what the role of the SEC would be is to ensure that whatever rules they're proposing has the resiliency and the important safety of a clearinghouse, because this is a systemically important clearinghouse. It's the largest, it's really the sole clearinghouse for equities. But I turn to Mr. Bodson.
Thank you, Mr. Bodson.
Thank you, Congressman. Distributed ledgers are very exciting technology. As was pointed out before, we have 2 projects on the way that are publicly discussing Project ION, which is using DLT for settlement purposes and digitizing securities. Project Whitney is more concentrated on the private security market and bringing some standardization, record keeping over those markets. What we're going to do, working with SIFMA and ICI and the entire industry over the next few months, is look at those business processes, look at those conventions that are out there, and see how best to deal with the impact of shortening time. As I said before, time is risk. You shorten it, your credit risk goes down, but if you shorten it without really understanding it, operational risk goes up, and all of a sudden you have a market in disarray. So, be it DLT, smart contracts, all these are exciting developments. The question is, what's the right time to use it? I mean, they're new technologies. I mean, we have 45 years of resiliency. I'm going to jinx our company, but we've had a great track record. So anything we do, we want to maintain that reputation for being, fortress DTCC. But new technologies are something obviously we're looking at, and it's very, very exciting for the industry over the medium to longer term that it could revolutionize what we do.
Very good. Thank you both. Chairwoman, I yield back.
Thank you very much. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome our guests to the committee today. And one of the things that I've been actually concerned about, more so than anything else, is the safety for the investor ever since the pandemic hit. And we've seen a lot of things happen within the marketplace. So, Mr. Bodson, are current broker capital investments sufficient to prevent harm to the investor and to the financial system?
Thank you, Congressman. It's a difficult question. What we saw during this period of time is obviously our requirements went up tremendously as a result of the market conditions, which were unseen. I mean, I have to be truthful that I've been in this business for 40 years, never seen this sort of concentrated activity in a series of stocks and the impact that it had on the market, therefore in the clearinghouse. What we want to make sure that people understand is our collection of the margin protects everybody from almost everybody. So, we talk a lot about what happened with Robinhood and their meeting the margin charge, which they did, and they've remained in good standing. But if somebody else had gone into default during that period of time, Robinhood nor Robinhood's clients would have to worry about trades being consummated. And I think that's the story that I think that is getting lost somewhat in this somehow, is that the system worked. I mean, there was incredible volumes. The system processed that volume. There was big changes in margin. Firms met that margin. Nobody was defaulted. Nobody was pushed into that situation from a firm basis. And the impact on the retail client, obviously, is something that both the SEC and this committee hopefully will come back with recommendations and views upon. But from our aspect, the post-trading aspect, it was an incredible period of stress. We then see this circumstances, but we were prepared for volume surges. We were prepared for market stresses, and that part of the process worked very well.
Okay, thank you. And this is important to the whole panel. Do you believe that gamification has a place in investing? And if so, what guardrails should be in place to ensure investors are protected?
So, Congressman, I thank you for asking that. This term gamification, which means embedding game-like features into applications, does not just relate to finance, it relates to our whole online existence. If I might say, the streaming apps figured out some time ago that I'm kind of a rom-com guy. Here, I admitted it on open. I see a number of members are looking up. You thought I was a thriller guy, but rom-com. But, you know, if I watch a rom-com that they recommend and I lose an hour and a half and it was a lousy rom-com, it's all right. But if you use gamification features and folks are trading more actively and day trading, then all of a sudden, that's their investment future. That's their challenges for their future and for their security. So I think we really have to take a look at this. We've asked the staff to put together something, request for public comment about all of these features that are getting imported into finance. Investing, good, but if it's sort of churning folks or getting them to invest, trade a lot, what does that mean? And what protections should we have in there in those communications?
That's a great answer, Mr. Chairman. Anyone else would like to comment on that?
Well, I would just add, I congratulate or applaud the decision by Chair Gensler to solicit comment on this topic, because I do think we want to make sure we understand it, the different features, what are they used for and why. We need to make sure we understand the benefits, and I believe there are some really important benefits for investors. We also want to make sure we understand the risks, and I believe there's some important risks. And I think the benefits and risks may change in different contexts. We also need to understand that. So I think we need to move forward in this area by really getting a process where there can be, everyone can, all the stakeholders can share their views, and the regulators can be even better educated. We fully support the concept of soliciting more comment in this space.
Okay, Mr. Chairman, one more before. So do you think that SEC broker-dealer capital and liquidity framework need to be strengthened for the larger retail broker-dealers? If so, how?
You raise a good question, because what we found in January is a number of brokers then denied access or shut out access, and it was about liquidity to the clearinghouse or margin in the clearinghouse. So we're taking a close look at that. But you raised a good question whether it also relates to their capital and liquidity needs.
Okay, thank you. Madam Chair, I yield back, but that is very, very important.
Thank you. Thank you very much. The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon. I appreciate the opportunity to participate in this hearing, and I know a lot of very important topics have been talked about. Chair Gensler, I wanted to speak directly with you for a few minutes. I was so encouraged to hear during your Senate confirmation hearing of your willingness to work on transitioning to an e-delivery system. Given the significant increase in communications via electronic means, it seems like a real common sense solution where consumers would win, ultimately firms would win, and everyone would be better off on account of this. So I certainly hope that this will continue to be a priority. Do you expect it to be a priority as you're getting started and spinning up in your new role?
I thank you. Yes, I was honored in the late 90s to work with Senator McCain on which was the e-signature bill that President Clinton signed. And so I think these are ways to bring efficiency. And look, the last 14 months we've been working through this pandemic largely because of some of those earlier reforms. It's been a very, very hard time, and too many of us have lost loved ones. But electronic delivery is something that I hope that we can continue to look to do while still protecting investors and ensuring they get the proper disclosures.
Wonderful. Well, I certainly appreciate that, Chair. I think this is an important area that we could wring a win from, both for consumers and their information, as well as for those that are providing it. Wanted to switch topics and talk about minimum tick sizes, though. I've mentioned in previous hearings that we've seen a dramatic increase over the last decade in off-exchange trading, with this year, at some points, frankly, more exchange happening off exchanges than on exchanges. And look, the reality is, I don't want this to be a matter of preference. I don't want it to be a matter of party, but I do want it to be a matter of parity, where we've got a regulatory regime that is equal across both types of trading. And I don't think we have that right now because of the minimum tick size requirements for lit or exchange trading. I wanted to reach out to you about this and help understand if there was any rationale for that discrepancy between on-exchange trading.
I don't know if we just lost the congressman, but I think I got enough of the question to answer it. Should I go ahead, Chairwoman? I don't know if
go right ahead.
All right, thank you. So one feature of our stock exchanges is there's a minimum price size of a penny, if I understand the question, or minimum tick size. I have asked staff to consider that in terms of market structure. Should that change? Should that address some of this segmentation that the wholesalers can trade within the penny, but on the exchanges we currently are not able to? And is that just a legacy of an earlier time?
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Madam Chair. You caught me by surprise with the technical glitch there. I really appreciate you all coming. Chair Gensler, I'd like to dive into some of the weeds here on payment for order flow, and I want to frame this in the context of Robinhood because it's top of mind in this hearing, but I think it's more illustrative of some challenges than the specifics for them. Number one, I would just point out that last year Robinhood was paid $65 million in fines for failing to disclose their reliance on payment for order flow as a revenue stream, and 65 million, 65. By comparison, they earned $91 million in payment for order flow revenue in the first quarter of 2020, $180 million in the second quarter of 2020, and $331 million, 5 times the fine, in the first quarter of this year. Now, you weren't at the SEC, and I'm not going to ask you to comment on that, but I would just make the observation that if the pain of the fine is so much lower than the benefit of the crime, I'm not sure it has the kind of deterrent property we would like. Now, in our hearing with Mr. Tenev, he noted that their payment for order flow agreements are structured where their revenue is earned as a percent of the spread earned by the wholesalers. Now, leaving the question of payment for order flow broadly aside, that seems to me like a total conflict of interest. The structure of that agreement puts the interests of the wholesalers and the brokers directly at odds with the investors, does it not?
Well, I think you highlight 2 really important points, if I may. One is that an enforcement regime, we should, I believe, without fear or favor, lean in to individuals and corporations and hold them accountable. And that what you're highlighting is sometimes just a dollar payment doesn't fully address holding companies or individuals accountable and change the behavior in the market. As to the behavior itself, what that finding in that case in December showed is that there was an inherent conflict, that there was the wholesaler saying, well, which way do you want me to go on this? It's either you or the investor. And so that's why I've asked staff. I think that we have to take a holistic look at the market structure and see whether, not only whether customers are really getting best execution, but how the market structure can be addressed to get that, and also address some of the increasing concentration in the markets.
Well, I appreciate that, because again, it's the structure. It's one thing to be paid 10 cents a trade. It's something else to say I'm going to get a percent of the spread. So the second point that Mr. Tenev said in those hearings was that, at least for their options orders, that they only route trades to the 4 firms listed on their 606s that they have payment for order flow contracts with. To my mind, I don't understand how that's consistently not even talking to firms who might be able to do this but don't pay you a fee on it. Would you agree that again, I'm talking about the structure of how you implement your payment for order flow, not the concept generally?
I think that you highlight a very good point, that in circumstances where you don't have that, then a broker sort of says, all right, I've got to institute best execution, and goes out and surveys. I think it was earlier, some congressman said it was a horse race, but you can go out and you can kind of say, all right, now I think it was Congressman Foster, but I be sure, who can I go out and sort of find the best execution rather than a limited 2 or 3, or in this case, 4 firms that are sending money back to the broker.
Okay, well, I'd like to then just tie this all to the gamification question, because I think all of us on this committee, regardless of party, want to see U.S. investors create as much wealth as possible. And I don't think any of us have evidence to suggest that retail investors, with high trading frequency come out better than retail investors who, just invest in index funds and are long hold, other than a couple lucky casino winners. And yet that is precisely what gamification is designed to do. And so if you couple gamification with an incentive based on the spread, and you couple that with only funneling money to people who are on the spread, it seems to me like I cannot conceive of a world where you are also fulfilling your best execution obligation. So in the time we've got left, what tools do you have to enforce compliance with folks who are violating that best execution? And can you commit to making sure that the fines are commensurate with the gains from the crime?
Well, that is certainly what we're going to lean in to do. I think that without individuals, and about sanctions and bars, and when needed to have orders that make sure of that.
Thank you. I yield back.
Thank you. The committee will be in recess for 5 minutes.
All right, I guess we got a 5-minute recess. I came back just in time. Make sure you hit that like button. I appreciate everyone hanging out here today. They will be back here in like 5 minutes. There's a lot of people in here earlier. You guys are crazy. Hope you're having a good day, though. Like, the views just spiked. But make sure you hit that like button. More beautiful people like yourselves will be able to find the channel. The more likes we have, it'll help YouTube suggest the channel to other people. Also, make sure you hit that subscribe button and that notification bell. We're live. Market open to market close Monday through Friday. So you're definitely going to want to hit that subscribe and notification bell, and you'll be notified the second we go live. And also when we post videos. God bless you. We appreciate you being here. We got about an hour left until the stock market closes here. I don't know how long this GameStop hearing goes on for. It's been going on for quite a while. I just think it's weird randomly. Like a bunch of you guys came in here. Earlier there was literally nobody in here. It's weird. The view ratio is really weird. Kind of annoyed about that spy play earlier. Yeah, if we would have just held it, we would have killed it. At one point, we would have been up like $100 if we would have just held it. But unfortunately, I stopped myself out for whatever reason. It's all good, though. We'll get one tomorrow. And the next day. And the next day. And the next day. The hell? Verizon's at 59? Oh. Still waiting. They should be coming back here soon. Whoever's here, make sure you hit that like button. It'll help other people find the channel and or the stream when these guys come back.
Order.
Oh,
The
they're back.
gentleman from Ohio,
All right,
Mr.
there you
Gonzalez,
go.
is now recognized for 5
Make sure you
minutes.
hit that like button. God bless
Thank you, Madam Chair, and thank you to our esteemed panel. Mr. Gensler, I want to start with you and thank you for your testimony and your thoughtfulness in today's hearing. It's our first time interacting, and it's great to meet you. I want to start with the Archegos situation. So, as you know, under SEC rules, any person or firm who acquires greater than 5% ownership of a company must publicly disclose, and then greater than 10% additional disclosures. Archegos, via swaps, had exposure, though not ownership, in excess of those triggers, and therefore they didn't have to disclose. Obviously, once the underlying shares started to tank, there were margin calls which they couldn't make, and then we had the disorderly liquidation. So my question around this is, from your view, how do we solve this going forward? And should the disclosures be triggered instead by exposure as opposed to outright ownership? Would that solve it? And if not, what sort of ideas?
I think you raise a very good point, and Congress anticipated this in reforms passed 12 years ago in the Dodd-Frank Act and gave authority to the SEC with certain conditions, but authority to bring what's called securities-based swaps into these regimes. So there's 5 and 10% disclosure. I've asked staff to try to prepare recommendations for the full commission. I think this Archegos circumstance where this family office had well in excess of those numbers shows some of the market-based and systemic-based reasons why, even if they didn't have the vote, it was an important set of exposures.
Right. And then with respect to this situation, from a systemic risk standpoint, do you think that Archegos was close to a long-term capital management style dislocation, or was it more a blip in the radar? You know, where are you on that? And I know
it's a very good question. I guess I've been around finance long enough that I was asked by then Secretary Rubin to visit long-term capital management in 1997. I don't know all the figures, but this was smaller, and it's 24 years later, than that circumstance had over $1 trillion of derivatives contracts on about $4 billion of capital. So it was highly, I would say highly levered. This was levered, as earlier members of this committee have said, pretty levered up, but I don't think it was quite at that level. But you raise a good point. There's systemic implications that we have to take the lessons, even when the system holds, take those lessons and adjust our rules.
Okay, thank you. And then, you know, with all the volatility that we've seen in the last year, whether it's GameStop or Archegos, I'd be curious what your thoughts are on the effect of the zero interest rate environment and sort of the messaging around it, basically saying, hey, look, we're going to keep it low for as long as humanly possible, and what that's done to risk-taking in general and leverage in particular. Just sort of your thoughts on that.
Well, I hope you appreciate it. I'm going to leave monetary policy to the central bank, and I think the remit under the securities laws are large enough that we're going to, regardless of where the markets are, up or down, interest rates high or low. I think our core mission of ensuring that we root out fraud and manipulation is a really critical piece. And what we found in the GameStop circumstances is that volatile markets, there's a time that also to be protecting the retail public.
Great, and I appreciate you not, I tried to get you to wade in there, but I appreciate the dodge. This isn't your first rodeo, clearly. On the PFOF situation, sort of following up on that, you know, when I look at GameStop, I see PFOF as sort of a bit player, but not the primary driver, right? It happens to be how Robinhood executes trades, but to me, it was a short squeeze of a handful of companies, but in particular GameStop, driven by social media and then traded on zero commission platforms. Do you agree with that perspective? Or, I want to make sure we're not adding payment for order flow as the primary driver of the GameStop situation, when payment for order flow has been around long before GameStop and hopefully long after. But I'd love to just hear you kind of put a bow on that if you could.
Yeah, I thank you. And this is in our remit, so I'll address it. I think that the GameStop events raised a handful of issues, and payment for order flow and the inherent conflicts that they present for brokers and their customers, we need to take a closer look at.
Thank you, Madam Chair, and I yield back.
Thank you very much. The gentlewoman from Iowa, Ms. Axney, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses for being here. Chair Gensler, it's great to have you confirmed and have the SEC back at full strength. It's obvious to everyone, that people trade differently and invest, and it's changed a lot over the last 10 years. And you know what? Contrary to what my colleagues on the other side of the aisle are saying, we believe in that. That's okay. But I do worry about some of the standards and protections for investors so that we can keep up with those changes. And recently, I've been very focused throughout this process on how new digital platforms have gamified trading and can be designed to influence behaviors within those users. And my husband and I own a digital design firm, so I'm pretty familiar with this. And one of the things I've heard along the way is that we shouldn't take away from some of those fun features of the apps. I don't disagree with that in general. However, at our last hearing, I asked Dr. Vicki Bogan, who is an expert in this area, about this, and she said that app design can absolutely influence the decisions people make while they're using that app. And so in this case, that app design can encourage riskier trading, which is literally the last thing investors with limited knowledge need. So Chair Gensler, what I'm wondering, is that something that the SEC will look at in evaluating whether the current regulatory structures are doing enough to protect investors against gamification towards riskier behavior?
Yes, Congresswoman, and I look forward to working with you. I think what we found in our modern internet age is that service providers outside of finance figured out how to basically engage us in a more fun app and make the user experience more enjoyable. Bringing that to finance, that can be good because it's easier to use the app, but it also can lead to high trading activity. And that high trading activity is really important. Tie that with predictive data analytics, some fancy words like deep learning and machine learning, but tie that to predictive data analytics, then they can say to Gary Gensler, this is the prompt you're going to get. And they can say to Chair Waters, this is the prompt she's going to get. And then they figure out, the computers figure out how to market to us differently. And all of a sudden, it becomes somewhat potentially behaviorally addictive. And you start to find that your returns go down. So I think it's a very important thing we're putting out to public comment to find from the public more about this area. I think it's best to get ahead of it than rather 5 years from now look back and say some problems have occurred.
Work with this. Also in this committee, we've looked a lot at the industries who have a business model where people aren't actually the customer of the service that they count on. So from student loans to credit reporting servicers, we consistently hear from those, about those businesses where we've got a lot of complaints from consumers. So Chair Gensler, since it's pretty clear that this is a similar situation, they're not the same, the customer really is Robinhood selling to the marketplace, the vendor, so not the consumer itself. I wonder, we've got a clear interest of conflict here when it comes to pay for order flow. And one of the things that is pretty clear from both news coverage and from these hearings is that this business with this is much of a conflict here. We don't have enough transparency around the PFOF, both for public and for policymakers to even understand. And I've had back and forth with Robinhood's CEO on this, and he said he'd send us that information for the PFOF. We're still, of course, waiting to see that since those currently aren't covered by Rule 606. So, Chair Gensler, I'm wondering if that's something that you would consider including in updating those rules, and what are some other options that we can look at to address this conflict?
I have asked staff to consider what should we do in terms of broad market structure, payment for order flow, and I would add the data is very valuable. I mean, what we find in our online life, if we're not paying, it's a free commission, it's often that somebody else is getting data. In this case, the data is the actual transaction flow. That data is very valuable to the wholesaler, the internalizer who's taking that order flow. And then, as we heard, maybe 50% of the retail flow, then they have a data advantage against all the other market makers, like a search engine that has data advantages against all other online platforms.
Yeah, listen, I can't wait to work with you on this. And I'll tell you what, I'm worried, while we all want people, of course, to be able to save and invest equitably, that what we've got right now could exacerbate inequity. So grateful to hear what you have to say. Thank you.
Thank you.
Thank you very much. The gentleman from West Virginia, Mr. Money, is now recognized for 5 minutes.
Thank you, Madam Chair. In the last 2 years, a record number of retail investors have opened brokerage accounts. Last year, individual investors' estimated share of equities trade volume reached a decade high. Although financial outcomes for individual investors will vary, I see increased participation in our capital markets as a positive development for wealth creation. Investors who bought shares of an ETF that tracks the S&P 500 on January 1st, 2020, would see roughly a 29% return on their investment today. That kind of return can make it easier to buy a house or save for a child's education. So my question, Chairman Gensler, do you consider increased participation by retail investors to be a positive development? And if so, how will market access factor into your decision-making at the SEC?
I think, Congressman, that market access is important. Market access and an informed public making their own risk decisions in participating in markets, and that these new financial technology apps have helped facilitate that. What we're also doing, though, is ensuring that investors are protected, and that we look at these gamification features and other prompts to see that they're still protected and they're not just encouraged in sort of in a method to trade more, chasing after something that behavioral prompts are encouraging them to do.
Well, thank you. As a good Republican, we always say, whenever possible, quote Ronald Reagan. So as President Ronald Reagan once said, government can and must provide opportunity, not smother it. Foster productivity, not stifle it, close quotes. So my fear is that overregulation could stifle the trend of greater participation from retail investors. Bad or just simply misguided legislation could have negative effects as well. Specifically, banning payment for order flow is not the right approach. If we ban payment for order flow, a practice that's been around for decades, I fear we may see the end of commission-free trading. And commission-free trading has been a driving force behind increased retail participation, and a return to commissions would make it harder for new retail investors to participate in our markets. The consequences of that could be devastating. As we discussed earlier, participating in our markets is a fantastic way for everybody in America, every person to build wealth. It is so I urge my Democrat colleagues to not get in the way of a good thing. Increased participation by retail is a positive development. Let's not regulate or legislate that progress away. Thank you, Madam Chair, and I yield back.
Thank you very much. The gentleman from New York, Mr. Torters, is now recognized for 5 minutes.
Thank you, Madam Chair. My first question is to Chair Gensler. Mr. Chair, do you believe there is an inherent conflict between payment for order flow and best execution?
We have, thank you, Congressman. I look forward to working with you. We have found, as highlighted earlier in the hearing, that there has been times where there's an inherent conflict, even when the wholesaler paying for that order flow has said, look, you tell me roughly, I can pay you more, I can pay the customer more. There are firms that have zero commission that don't have payment for order flow. And also to the earlier question, there are countries, the United Kingdom banned payment for order flow. Canada has banned payment for order flow. So I've just asked staff to let's look at this holistically as to what promotes fair, orderly, and efficient markets, protects investors the best.
I'm curious, at the moment, do you ever, if I were to ask you, because payment for order flow is clearly a trade-off. It has benefits, it has cost. Do you have a position on whether the cost outweigh the benefit at this moment?
I still want to hear from staff and work with my fellow commissioners. But to your earlier question, there is this tension. There is a conflict there. And it's also led to a handful, really one or two wholesalers to have a dominant share in the retail market. And that concentration also raises issues of fragility, the data that they have, do they get a competitive advantage on the rest of the market? Concentration usually leads to less efficient markets.
Now, it's often said zero commissions trading is free, but there's a sense in which it's deceptively free. It has no cost at the front end, but it certainly has a hidden cost at the back end. Do you agree with that assessment? And how can we make that hidden cost more visible to retail investors?
It's a very good question, whether, because there are costs. There are costs. It's sort of like an iceberg, but most of the iceberg is below the surface. The costs are below the surface. Payment for order flow is one of the costs. The data that someone else in the market gets enough data to trade that market better for them and a little less well for everybody else.
You mentioned, two concerns I have is market concentration and systemic risk. It's been reported that Citadel controls 47% of the retail order flow market. It's also been reported that Melvin Capital, which sustained 51% losses in January of 2021, was heavily leveraged. How are we going to address market concentration and systemic risk in this market?
I think by thinking through as best we can how to instill through market rules and transparency, vibrant competition. And vibrant competition so that one firm doesn't necessarily, through economics, get to that center and get to dominate. We see concentration also on the brokerage side, increasing concentration on the brokerage side. So it's not just on the market making side. And that's what I've asked staff and our Division of Economic Research and others to work at.
And as you know, there was controversy around Robinhood's decision to restrict trading. I've heard the arguments. I, for one, actually find the arguments to be reasonable. It seems like Robinhood would have had the inability to meet margin call. But it raises a larger question for me. It seems to me the ability of a broker to restrict trading appears to be absolute. I'm wondering, should there be any limits on the ability of a broker to restrict trading to ensure that it's done reasonably and that there's no abuse of power?
So I think what happened here is to protect the clearinghouse and protect it, because this firm didn't have enough liquidity and they scrambled around to raise a little over $1 billion that fateful day. They and some others restricted trading. I think access to the markets is a fundamental part of the markets. And so the folks that took it on the chin, so to speak, were people that wanted that access at that critical time. And so we're looking at that very closely at the agency.
But should there be limits? Yes, sir. Should there be limits on the ability of a broker to restrict trading?
Again, it's only my third week of the job, so
you've been thinking about these topics for a long time.
I understand. I would have to say, whether you're the smallest investor or the largest investor, one of the hallmarks of our markets is access to trading. And so it does concern me that retail investors were shut out during a fateful time. But again, there's a balance. They had to protect the clearinghouse as well.
Thank you, Madam Chair.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member McHenry, and thank you to our witnesses for your testimony and participation in today's hearing. Chairman Gensler, I want to welcome you as well to your first appearance before the committee in your new role. Historically, the SEC has administered the federal security laws in a bipartisan fashion. Chairman Gensler, I hope you continue that tradition, as I believe discussions about security laws are not where we should be holding debates about climate change or racial inequalities or other extraneous issues. As the American economy continues to recover from the government-imposed shutdowns due to COVID-19, I also urge you to avoid placing overburdensome regulations through backdoor regulating that could lead to limited consumer access to credit or stifle job growth. As we analyze the events surrounding GameStop, we again are discussing payment for order flow, a conversation that has been ongoing since the 1980s. I'm not in favor of banning payment for order flow like the legislation my Democratic colleagues have introduced to this hearing, especially without the proper due diligence of studying its benefits and costs. The updated reporting requirements released in 2018 were a good first step, a good step forward, but I think we should continue to investigate if those changes are providing the necessary transparency for investors. Chairman Gensler, in the previous hearing, I asked one of our witnesses what reforms he thought the SEC should implement or could implement with respect to payment for order flow to increase transparency for retail investors, and he suggested more granular 606 reports, specifically doing more to provide better public transparency of best execution. Are you looking into additional changes to those reports? And if so, what changes?
So I thank you for that, and I look forward to working with you and your staff and bipartisanship in any way that your advice. I want to turn to your question. I think transparency is very helpful, and transparency around these potential conflicts. I don't know that that will get us all the way there, and that's why I've asked the staff as to market structure, and more broadly, not just about wholesalers and brokerage shops like Robinhood, but also exchanges and brokerage shops which pay rebates. And that whole market structure, what's going to promote the most competition, the most efficiency. So when a company goes to raise money, they have the most efficient markets. And when work and family save, they can save best for retirement. And at the middle, if we have concentration often economic shows leads to higher economic rents and higher costs. So competition in that middle of the market is what sort of is my question to the staff.
What is the time frame and prioritization for your examination of payment for order flow?
Again, just 3 weeks in the job, so I don't know which month, but just because the chairwoman asked to have this hearing, you can imagine we've spent a lot of time just in the last 2 weeks. We're looking to probably publish a GameStop report this summer, but that won't be the only piece of it. It's really looking at what should we be doing in terms of overall market structure and whatever rules we can do, whether it be, as you said, updating our transparency around this Rule 606 or going further.
Thank you. Mr. Cook, in your written testimony, you said that the SEC's 2018 disclosure requirement updates that took effect in 2020 have increased the public transparency of payment for order flow, but that FINRA believes that additional updates to order routing disclosure are necessary. Could you describe what updates you are planning to recommend?
Thank you for that question, sir. I think we'd like to explore with the SEC to build on, I think it was a very positive development, the 2018 disclosure you're referring to. It just became effective in 2020. A lot of the debate around payment for order flow now is informed by that additional disclosure. So I think that's been very helpful. The question is whether there might be more granular information about payment for order flow. We might think about some of that being reported to regulators to help them investigate how orders are being routed. But also more disclosure to investors, and that might be enhanced 606 reports or considering disclosures at the point of sale.
Thank you, and I yield back, Madam Chair.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for holding this hearing, and thank you to our guests today. Chair Gensler, first of all, congratulations on your confirmation. I want to focus my questions on increasing transparency within the markets. As you know, on a quarterly basis, some of our largest institutional investors must disclose their equity holdings via Form 13F. However, both the GameStop and Archegos controversies have highlighted some serious weak points and loopholes in Form 13F. Which for example, Archegos, which caused billions in losses for some of the world's largest financial institutions like Credit Suisse, was able to skirt disclosing its sizable derivatives positions because Form 13F doesn't require covered flyers to disclose. So, as chairman of SEC, what reforms to 13F do you believe need to be made to provide more transparency to the markets and investors? And do you believe that 13F filings should be expanded to include derivatives?
Thank you for that question. I do think, and Congress anticipated this by giving authority to the SEC to do that. I think these derivatives, or what's known in this case as total return swaps, being included in those filings would be positive. I can't speak on behalf of the commission. I'm just speaking on my behalf, but I've asked staff to prepare recommendations to the 5-member commission to use that authority that the SEC has. I also think that there might be other updates that we should do beyond just derivatives as well.
Okay. Thank you, sir. Mr. Bonson, Robinhood CEO blamed the trade settlement cycle for Robinhood's inability to meet NSCC's margin demands, which he says forced Robinhood to restrict trading in GameStop stock and other stocks so it could reduce its risk profile, therefore reducing the amount that it would have to pay into NSCC's margin fund. So, Mr. Bonson, can you please describe generally what factors NSCC uses to determine a member firm's risk profile, and estimate how often it is that a member firm is surprised at the amount it has to pay into a clearinghouse's margin fund?
Thank you, Congresswoman. Our formulas, our models are all SEC approved and subject to public commentary. The model is commonly known as a value at risk model. It is a statistically widely accepted and supported model to estimate the potential loss that the portfolio of open trades that a firm has. What's the loss over the 2-day period to settlement? In the case of Robinhood and others, because they were not the only firm that was facing these situations, the model saw that they had large concentration of transactions in buy. So they were, instead of a portfolio of buys and sells, they were all buy trades in stocks that were moving around 100 to 200 to 300% a day, which is incredible volatility, and with volumes that were over 100 times above what would be normal. All these factors lead the model to say this is a very risky situation. If a firm defaults, there's a possibility of those stocks losing all their value in an equal period of time. So that's what drove the margin charge from Robinhood and some other firms where you saw this heavy retail flow. We provide our members the model itself in our rules. We have model guides to help them understand it. We have APIs which sends information to the firms. We have a customer portal where they can see what we're seeing. Now, the model itself runs overnight. So one can understand a firm may not know the exact precise amount that may come out the next day, because especially in this type of marketplace, but they can anticipate that there will be a significant increase overnight as a result of seeing their customers' activity coming through them.
Okay, so we know that it was an unprecedented week, but do you believe that it was the settlement cycle that's to blame for Robinhood's margin issues, or is this just a case of poor risk management?
Well, I think it's more a question of, if there was a shorter settlement cycle, yes, the margin charge would be reduced, because that period of time maybe would go from 2 days to 1 day, and therefore the portfolio of open trades would be lower. The volatility would not have to be over 2 days, but to 1 day. I'm not sure blame is the right term for a settlement cycle. That simply is an industry convention.
Okay, thank you. Madam Chairman, you're back.
Thank you. Thank you very much. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you very much, Chairwoman. I don't know about everybody on these virtual hearings, but man, I look forward to the majority allowing us to be back in person in the not too distant future. I think it'll be really nice just to actually see people instead of doing this virtually on some pretty important topics, but away we go. Mr. Chairman Gensler, really appreciate you being here today. At the hearing last month, I asked Acting Director Coates about some statements he made regarding the SPAC market in his then temporary capacity as the head of the Division of Corporation Finance. As you know, in my opinion, his comments had some pretty impactful effects on the SPAC markets. Acting Director Coates was hired by Commissioner Lee when she was the acting chair, but Coates has remained in that role under your chairmanship. In fact, several of the commissioners Lee's hired have remained in prominent roles, including your chief of staff. Do you intend to retain Acting Director Coates as the permanent head of the Division of Corporation Finance?
thank you for that, and I look forward to working with you. John Coates is a valued member of the senior staff of the SEC, and while I only met him recently, he's contributing and working really well.
Fair. Did you provide any consultation with Commissioner Lee about or exert influence over staff hiring, both in the roles of the chairman's office and for the SEC divisions prior to being sworn in as chairman?
No.
Okay. That's helpful. Do you have any input into the hiring of acting director Coates then? No?
As I just said, no.
Okay, I'll shift gears. Let's jump into a favorite topic of mine, ESG disclosures. I've been concerned that our securities laws are going to be misused to push social policy agendas that are at best tangentially related to investor protection and capital formation. And with that in mind, I want to ask you about Commissioner Lee's recent remarks at the Center for American Progress. Because in her speech, Commissioner Lee suggested the SEC should focus its attention on political disclosures. She said the following, quote, many companies that have made carbon neutral pledges or otherwise state they support climate friendly initiatives have donated substantial sums to candidates with climate voting records inconsistent with such assertions, end quote. And I'm concerned that pursuing policies like this at the SEC is going to lead to mandatory disclosures of information that aren't material to your average investor, and that is instead really an attempt to leverage the SEC to engage in naming and shaming. Did you, by chance, discuss Commissioner Lee's remarks before
this
she made
is
them?
GameStop hearing.
Congressman, I was a private citizen at MIT.
But I hope you're having a good day, Jake.
Completely fair. So on the record, you were not engaged in providing advice on those comments or in consultation.
Until I was honored by the U.S. Senate and appointed by the president, I was at MIT as a professor, and
totally fine. Just wanted to confirm that was the case. Do you think, with all the critical challenges we're facing today, and in particular in front of the SEC, do you feel at this time you intend to prioritize that issue?
I am, sir, and let me explain why. I think that our markets, our core to our market structure is disclosure, and investors being able to decide what risks they take based upon the disclosure from issuers. And this decade, the 2020s, the climate risk is something that increasing number of investors, measured in the trillions of dollars, have really said this is something that they want to better understand as they make their investment choices. And I think we can help bring consistency and comparability. I think we can do it through notice and comment. There's a comment period that Acting Chair Lee actually started. I didn't have a part of that, but she started Acting Chair Lee. We're gonna get a lot of comments from the public come June, and I encourage anybody to weigh in for, against, the details. Really helpful to learn from the public their views on this. But it's about the investors and disclosure that investors want in making their investment and proxy choices.
I appreciate you answering. With the limited time, I say I look forward to the discussion, look forward to working with you, and appreciate you attending today's virtual hearing. And with that, Chairwoman, I yield back.
Thank you very much. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Chair Waters and Ranking Member McHenry, for holding this hearing today. And thanks to all the witnesses for your informative testimony. This is the third hearing we've had about.
All right. I'm over this hearing. Let's get on to the earnings. Let's get on to the earnings here in like 20 minutes. That was interesting. Hope you guys enjoyed that. Now I gotta change the title of the stream to what it was earlier. Or wait, I could probably just do this. Bop. AMC, Roku, Peloton. There's quite a few. Nice. I guess the stream getting clapped earlier was beneficial. Because now I just got to copy and paste everything. That was nice. Very convenient. Any purchase today? Nah, no purchases today. Kind of want to buy more shares of AMD. But we're just chilling. I should have bought more shares of Apple and Microsoft today. But I mean, maybe we'll get another like week of downside. Be able to pick up a lot of stuff. But I mean, it's a long-term portfolio, and the market's been getting clapped, so it's pretty clapped for now. But it's a long term, so patience. All right, Jake. God bless you, bro. SPY is popping. $131. I don't know. Depends how the market plays out. I wouldn't really mind having a few more days of downside. Be able to pick up a lot of stuff on the dip. Got about 15 more minutes till the market closes. The I ticker's beastin'. I bet the long term still clapped though. Yeah. Not as clapped as it was. Yeah, we definitely need a couple more days of downside. That'd be nice. Be able to make some moves on some longer term options and buy shares. Damn, DraftKings got clapped all the way to $50. That's crazy. That SPY ripping though. Damn, bro. SPY just hitting all-time highs, I think. Or maybe it's just highs of the past few days. I don't know. All-time highs is 420.50. Never mind. Back up on that bullish trend, though. Got about 10 more minutes. Oh, damn, that high ticker is going nuts. Goldman offers new Bitcoin derivatives to investors. I feel like that's old news. 5 more minutes. Damn, FedEx 311. Already smashed that like button. Let's go. Much love, Elvis. Damn. That high ticker, though. Such a good buy the dip day. Buy on the dip. Got about 1 more minute. Got about 10 more seconds. Oh yeah, my clock's like 13 seconds behind though. So now we got about 10 seconds. Woo. Spy killing it. Feels bad for not buying any shares on the dip, Because now we probably boosting. Ding, 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 ding. Damn, we like 20 seconds behind on the clock. All right. That was the day, I guess. Oh, yeah, we got earnings after hours. I forgot. Let's see what these earnings bring us. Where's all the stocks that report? I forget the list. Let's see, we got Square, Roku, Peloton, AMC, Cloudflare, Beyond, Dropbox, GoPro, Datadog. A lot of earnings. Let's see what they bring it. What they bringeth. Twitter introduces a tip jar. They're kind of popping off that. NASDAQ's still ripping. We're just waiting on the earnings here. I don't know what Pton is, but that thing had really bad earnings, it looks like. It's probably this one. Damn. That thing dropped $10 or over $10. I don't know what Pton is though. This thing looks like it's kind of in the gutter. SPY and NASDAQ are still going. There's Peloton. Not seeing the earnings on Peloton, but the stock's popping. Dropbox EPS 0.35 beats 0.3 estimate. Sales 511.6 million beats 505.18 million. I forget Dropbox's ticker. Looks like the stock didn't even react. There's Beyond on the low ticker. Beyond is getting slaughtered. TripAdvisor, Q1 adjusted loss. 39-cent estimate. Oh, the estimate was 33. TripAdvisor Q1 revenue 123 million, estimated was 119 million. Peloton Q3 EPS. Wait. What? Oh, okay. So Peloton's was negative 0.03 versus negative 0.11 EPS. Revenue 1.26 billion versus 1.11 billion. That was Peloton. Damn, Beyond's getting slaughtered. Wonder what Beyond was pricing in. They're getting hammered. Beyond was pricing in about $11. That's about what they fell. Still waiting on AMC, Roku, Datadog. There's still a few more coming out. So far, nothing special besides Beyond. Beyond moved quite a bit, but still within expectation. Beyond's 108 right now. Damn, Square on the low ticker. That's not good. Not good for me. Yep, Square's getting slapped. I bet Square was pricing in a lot, though. So it wait. Yeah, Square was pricing in $11 as well. It's pretty much what it dropped. Not getting the report. Damn, Square's getting slapped. That's not good for me. That's what I get for not selling it on the high when I knew it was a more risky stock. It's all good, though. We just hold it. Who cares at this point? For some reason, all the other earnings reports aren't coming in. GoPro revenue of 204 million, up 71%. So GoPro had pretty good earnings, just the stock didn't react that well. Where's Square's report? I don't even think Square's report came out yet. They're just dumping the stock. Expedia Q1 sales 1.246 billion versus 1.12 billion estimate. So Expedia and TripAdvisor did pretty well. I don't even think Square's earnings came out yet. For some reason, the stock just got dumped. I don't know what's going on there. Because now it's popping. I don't know. I don't even think the report's out yet. We're still waiting on AMC, Datadog, Square, Roku. Still a lot of reports that haven't came out yet. GoPro just hit $11. GoPro had really good earnings. I think Square's earnings are out. I'm just not getting the report here. I don't know. Ah, there it is. Square reports Q1 0.41 versus 0.16 estimate. Revenue 5.06 versus 3.137 billion estimate. So Square killed it. Their Bitcoin revenue is 3.51 billion versus 2.06 billion. So Square killed it, which is good. I thought we were going to get clapped on those shares. Low key. Tech is in for a massive correction. You're telling me the 10-15% it's already dropped isn't a correction? I don't know about that. Like, literally. Have you looked at the NASDAQ chart recently? Because it's already dropped like 10%. That's crazy. I mean, you can talk all you want, but until you're shorting it, then there's no point in even talking about it. Just saying. I don't see you in a short position on it, so I don't know why you would even be talking about it. Low key. That's the funny thing about the stock market. Everyone wants to talk about where the price is going to go, but they won't put their money where their mouth is. That's why I put all my money in the long term, because I'll put my money where my mouth is. There's Roku. Yeah, you could have killed it on the Roku dip. Ooh, damn. Should have bought those shares of Roku. I'm such a little paper-handed bitch, bro. Roku killed it. Roku killed it, bro. Roku Q1 EPS 5.54 or 0.54 beats a negative 0.15. They have a negative estimate on Roku. I didn't even know that. Sales 574.18 million beats 490.56 million. Roku destroyed. I mean, all I'm saying is, if you really think the market's gonna drop, then short it. Don't just talk about it. That's all I'm saying. I don't want to. We don't need to continue this conversation, because if you're not shorting it, then there's no point in talking about it. That's all. That's all I'm saying. We're still waiting on AMC here. you don't short, then I don't know why you're talking about where something's going to go, because you're not confident in it if you're not going to short it. Do you see what I'm saying here? Like, there's no point in saying something's going to go to a specific price if you're not going to play it. Like, that's all I'm saying. If you're just speculating and you're not playing what you're speculating on, then there's no point in even having an opinion about it. So you're telling me the Nasdaq's going to drop 5% tomorrow, or yeah, literally tomorrow. I thought it was Wednesday. You're telling me the Nasdaq's going to drop 10% tomorrow? Sorry, that's statistically very unlikely unless the whole market crashes. It could drop 1%, it could drop 2%, but yeah, it's not going to drop 10%. Sorry to say. Just your crap tech. That's still statistically very unlikely. The only stock that was down over 10% today was Redfin. Everything else is 8, 7, 6, 5. So, very unlikely. You might see one stock down 10%, maybe two, but not everything. That's not how price action works. Oh, TrueCar had earnings? Oh, let's go. That TrueCar coming back up. All right, bro. You want to know how many times I've been told that the market's going to crash? Like, just, yeah. If you want to watch big money shift and you want to catch a real crash, watch the bond market. Until your short-term bond yields are going to start coming up, you're not going to see a crash. You could see a correction, which we've already saw. This whole week's been a correction. Just the shit tech stocks. Well, you're, like I said, you. All right, I'm over this conversation. There's AMC. Like, I don't get how you're literally just speculating. You're not even saying a specific stock. You're literally just speculating. Like, I would rather bet that the market's going to go up 1% tomorrow than bet that everything's going to sell off. Nah, I'm going to hold my long-term positions for the next 5-10 years. Okay, well, AMC earnings went out. Stock didn't even move. So the only exciting ones were Roku and Beyond. Kind of sad I didn't buy shares of Roku. But it's okay. Maybe we'll get another opportunity. I mean, maybe Elvis will be right and we'll drop 10% tomorrow. I mean, I'd love it. Then I'd just load up on more shares. So, I mean, hopefully we drop 10% tomorrow. That'd be beautiful. Not saying I don't want that to happen. I'm just telling you it's very unlikely. And it's very speculative. Yep. That was fun. That's the end of the day. Look at your crap tech. Talk to me in 5-10 years. And then let me know where silver's at. Let me know where gold's at. Let me know where oil is. Because I don't care what's happening right now. Let me know when the bond yields or the short-term bond yields actually go up, and then I'll show you where the real money's going. Until then, it's all speculation, but I'm over this conversation. I don't know why you're ruining a perfectly good earnings season by talking shit on the stock market and speculating. But God bless you. I'm out. I love you guys. I'm not going to do the spiel. Just know I appreciate you guys hanging out. And yeah, we'll see you tomorrow.